Good morning. What's going on, everybody? Good morning. Welcome to the room. Happy Friday. We made it through another week. I'm pretty excited. Hey, Vittorio. Good to see you. Yeah. Love it. Jerry S., good to have you. Erla, Bob. Man, you guys are crushing it today. Doing some stuff, making some money, taking some trades. I love it when that happens. Hope everybody's doing well. Steve, good morning. Gary, good morning. Steve, you inspired me yesterday to go back and do some historical study. I appreciate that. Had a revelation about it and a way to help you guys study more effectively. So good stuff. I appreciate that. I owe you one. Guys, I'm Mark. I'm going to talk a little bit. You're going to talk a lot. We're going to talk about a pattern. We're going to talk about a pattern that has been proven, is back tested, is testable, is verifiable, and this pattern is a pattern that produces the ability to win more than you lose. That's our goal this morning, and then we're going to talk just bunches about everything you guys need to know about. Good morning, Better Dad. But before we get going on the good stuff, guys, we have to check news, have to make sure there's nothing going on that could upset our patterns. Today is Friday, May 30th, and at 8:30 a.m., you see that red box. That was the core PCE price index, M&Ms, I think. M&Ms are delicious, guys. They melt in your mouth, not in your hands. I don't know what that is, but what I do know, hey, Izzy, good to see you in here. What I do know is that there's a red box, high impact, and man, these are the things that can disrupt the market. They're not guaranteed to disrupt the market, but when they are present, when I know that there's high impact news, guys, I know that my advantage has gone away because that unpredictable nature is there. So choose not to trade. I sit on my hands. I go toast a bagel. I do anything other than throw myself in front of that emotional freight train. At 10 a.m., we have the revised University of Michigan Consumer Sentiment. It is medium impact. And what that means is there could be some Yahoo with a lot of money that makes a decision. It's not as impactful typically as the high impact, but this still has a little bit of potential to move the market, to shake it, to knock you out of a position. When I see an orange box, I protect myself. If I'm deep into a trade, I'll lock in profits, make sure if there is a spike, I can survive it. So every morning, checking Forex Factory, making sure that I know when the crazy may happen. And then all the stuff I talk about is coming from the Nexgen page, guys. I mean, everything that I talk about. If you go to the trading guide, and you know what? Let me F5 this real quick because one of my favorite Novaks took good care of me. This is the user guide, and this is really how I get my answers. I know you think I have it memorized. I don't. I come check it every morning. The first section is the trading plan rules, guys, and this is where our first hour comes from. We spend about 45 minutes to an hour each and every morning. We're talking about one trade. We're talking about what's called a high probability trend trade. A high probability trade means that each indicator on every chart agrees with the rules for the trade. This is when triggers are the strongest, no termination conditions exist, guys. There's nothing between you and your targets. So in our first hour, we literally talk about the absolute best of the best way for a brand new user to get comfortable with the software, to get integrated into the software. And we do it with such a high probability trade because success, guys, it breeds confidence. It really does. And the more confident you are in your trading plan, the less likely you are to deviate from it. So that's what we're going to do this morning. I'm going to give you the rules. I'm going to teach you how to find them. We're going to go through everything. And one of the most important reasons that we're starting with this high probability trend trade is this is the trade that teaches you to read your indicators. And it's funny because when I started my journey and I said, you know what, I want to be a day trader. I want to make money. I want to make all the money. I want to make so much money that I have absolutely no worries in the world ever. That's what most people do. They're like, I want to get to that level. You get that way by being a successful chart reader, I believe, because Trading isn't about your desire to win. Trading isn't about your need to pay bills. Trading isn't about your wants and hopes to show off in front of your friends. Guys, day trading is a business, and a business plan puts you in a position to make the most money. And what happens is we're going to talk about these three trading rules, this one trade, and this is a plan that has been proven to win more than it loses, guys. And we're going to trade the patterns, and we're going to focus on the execution of the method. And what happens when you focus on the execution of the method, typically the results follow. So it's only three rules, guys. And once you learn to read your charts, the one thing that you're going to realize is that most of your day is reading charts. Most of your day is waiting for advantages. Most of your day is playing solitaire on the side monitor. 10% of your day will be actively trading because you can say without question, without hesitation, that you have an advantage, that you have an edge, that you're witnessing a pattern that has been proven to win more than it loses, and you can't wait to enter the market. With a little bit of study, a little bit of practice, taking a few pictures and writing on them, you will understand where the market is likely to continue. You're going to use this for the entries for the high probability trend trade. You're going to understand where the market is likely to go. This is going to help you a lot with profit targets, understanding where momentum is pushing, and you're going to see key areas off in the distance, and you're like, that's where I'm holding for. And then finally, you're going to understand where the market is likely to stop. These likely to stop areas are what we call termination conditions, guys. This is going to be rule number 2 for you. And these likely to stop areas can end a trend. You always hear the old thing, hey, buy low, sell high. Guys, you're going to know where low and high have the potential to be using Fibonacci. And I'm going to teach you how to recognize it, how to capitalize on it. So we're going to learn to read our indicators first. That's the goal. And then because we're chart readers, we're going to become day traders. Day one. Who's new in here? Let me see. I'm looking. Todd P, I know you still consider yourself new, but you're over this part, right? Guys, the first couple days is learning the language. The first couple days is just getting your feet wet, not feeling so awkward in a room full of strangers. And right around day 3, the language really starts to kick in. Typically by day 4 or 5, my new users are pinpointing these great entries. So if it feels a little overwhelming, trust me on this one. We've all been there and we've all grown out of it. It gets better, it gets easier, and clarity comes if you keep it simple. Let's talk about the indicators that we're going to use. If we're going to learn to read them, we have to know what they are. So there's going to be small triggers. These are 2 solid lines. These work together. They're a fast-moving average, guys. When they're green, they're going up. When they're red, they're going down. And then there's the large triggers. These have dashes on them. And these large triggers, again, when they're green, they're going up. When they're red, they're going down. The beautiful thing about what we're doing here with Nexgen and these indicators and everything that I talk about is you don't have to know any of the math that creates these triggers. You don't have to know how to program them. There's no adjustments to make. The only thing you need to know is that these are small and these are large. And guys, we're going to use triggers to define each and every rule. They're going to show up in everything you do. Know the difference between the two. And we're going to have areas, guys. And areas are how you're going to pinpoint where the market is likely to bounce, where it's likely to turn, where it's likely to continue. They all have names. And once again, that's all you need. You need to know that if a magenta line prints off of a pivot, this is a divergence high. And divergence means there's a loss of momentum. That's it. The market was pushing up, it headed back down, and your software says, hey, guess what, Todd? Things were slowing down right at that pivot. Here's a magenta line to remind you. There's Fibonacci resistance. When the market's trending up, this is a point where the market could stop, could bounce, could reverse. Fibonacci support is the same thing when the market's trending down. These are bounce points. These are where decisions are being made. There's yellow 1-to-1s. They can act as support or resistance depending on the direction of the trend. There's the divergence lows, just like the divergence highs. Maybe the sellers are in control. Everyone's pushing, and then right here the buyers take over and they steal the momentum. There's losing momentum in the move. You're going to see it with a cyan line. And then there's the midband that runs right through the middle. And this midband changes colors depending on where price is trading. So if price is below it, you're going to see a magenta midband. That could behave as resistance and stop that upward progress. And if price is above it, it's going to turn green, letting you know that it may behave as support. So You don't have to know how to calculate Fibonacci. You don't need to know anything about MACDs to know that there was a loss of momentum, guys. All you need to know is what these look like and give them a name so you know what they mean to you. We're going to take these indicators and we're going to break it down into 3 rules. That's it. Simplicity. Can't stress that enough. Each rule, when it's true, provides an advantage. So the rules are in white, the advantages are in yellow. Your recipe for a trade is momentum plus a clear path and then defining your entry area. I'm going to break down each rule individually for you this morning. We're going to talk about what they look like, what they mean to you, how to study them. I'm going to give you all the tools you need to take 3 parts and create the whole. We're going to do it on only 2 charts. There's a large chart, and I love this phrase. I've got it spray painted on the wall here. Large chart leads the way. Large chart tells you to go look for an entry, guys, because your large chart's a really slow moving chart. It's a broad stroke of a brush. It shows the overall opinion of the market. And it only takes 1 bar on the large chart. And you'll be able to define the direction. You should be looking for rules to be met. You'll be able to define the momentum of the market, and you'll understand if there's any areas in the way. Rules 1 and 2 are met on this just 1 bar. That's all it takes. Once the rules are true, once you have momentum, once your path is clear, you're going to go to a smaller chart, a faster chart. Let's just call it a refinement chart. This yellow box surrounding this 1 bar, giving all the good stuff, all of these bars live inside of it on a small chart. So we use the small chart to pinpoint where the market is most likely to bounce, where it's most likely to continue with the trend from the large chart. It's this refinement process that's going to allow you guys to reduce risk a lot. And it's also going to get you into the market furthest away from your profit target. So it's going to give you the ability to pull a little bit more on the trades as well. These 2 charts can be best represented by this picture. The large chart, guys, it's the big crowd. They're in control. You're not. You'll never be in control. That was hard for me to come to terms with. That my 2 contracts couldn't move a market. Oh man, killed me. Guys, there are men and women with pockets so deep you'll never see the bottom of them. They create trends. They establish momentum, guys. They react at those key areas on your large chart. Large crowd wins. Your path of least resistance is simply trading with them. When they say we're going up, go up with them. There is a small crowd. They have really deep pockets too. They're so much more important than you and I. You and me, excuse me. They fight. They're mad at the large crowd. I don't know why, but they create these little rifts, these little pushbacks, these little retracements. When the large crowd says, hey, we're going up, they say, nope, we're going down. That's cool. They can create a little movement. We rely on their movement. But guys, their fight, it fails typically 70 to 80% of the time. Your rule number 3 on that smaller, faster chart is going to have you pinpoint right where their fight is most likely to lose out, right where the market is most likely to bounce, and that large crowd's going to take over and push the market up against their little fight. So know who you're trading with. Know who you're trading against, guys, and there definitely is a path of least resistance. We are going to learn the trigger line and the Fibonacci rules for when it's okay to trade. When is it okay to trade? It's okay to trade when my rules are met. Because my rules, your rules, I hope, all they're doing is they're describing a pattern that has been proven to win more than it loses, guys. So this is no different than weighting one side of a coin, flipping it 100 times, and knowing, proving that it's going to land on heads 80% of the time. Your goal is to only bet on heads because it provides an edge. That's what these rules do for you. You have the ability to simulate. Is the sound cutting in and out? Let me make sure. Is that better? I'm pushing in connections. Sorry, I'm nervous energy and I'm playing with the cord. I'll leave it alone. That was probably me. Probably me. My apologies. Yeah, always let me know though. Back now? Cool. Guys, I want you to simulate, to practice, to take advantage of having an arena where there is no threat of loss of capital, guys. The simulator is your batting cages. The simulator is your driving range. It's your after practice shooting free throws. You can't lose the game, get a double bogey, or strike out on simulator. All you can do is become a better trader. And I'm here to help you with that. So as you simulate and as you practice these trades and you work on getting in and getting out and management, take pictures. Every time you take a trade, take a picture. Take a picture of your big chart and your small chart together. Address the momentum and how you read it. And talk about whether or not you had a clear path, what you were thinking, and show me your entries and show me your exits. And what you're going to do is every time you post in the room, guys, you're going to get a private session with me. We're going to look at what you did, how you read your indicators, where you entered, where you exited. I'm not going to judge you on the quality of your trade. We're simply going to talk about advantages, whether they were there or not. And if I see a way that could help you make a little extra money because you have less risk or more profit potential, we'll talk about it. We'll address it, and we'll even address some of the patterns that we see in the market that could be impactful on your trades. I will give you everything rattling around my brain to make you a better trader. All you have to do is post in the room, guys. That's the first step in becoming a confident trader ASAP. The second thing is keep it simple. Um, Day trading doesn't have to be difficult. I can't stress this enough. Day trading doesn't have to be stressful. Day trading doesn't have to be a feeling of guesswork. Day trading, and the most competent, successful day traders I know, do the same thing every day. They wait for a pattern, and when the pattern isn't present, they have trained themselves to sit still and do nothing. It's an art, and it will take a little bit of time. But if you keep it simple, and I'm going to hand you a plan with only 2 trades in it. If you keep it simple, if you look for the best trades rather than all the trades, if you realize that the futures markets trades trillions every day. Guys, the S&P exchange is $174 million a day on average. You need to capture 400 of that to be a 6-figure trader. So keep it really simple. Learn the looks you're going to commit to. Learn them so that they become easy. And that's the idea of using the spreadsheet that I'm about to give you, because there's no doubt in my mind, repetition creates recognition, guys. The more times you see something, the more times you do something, the more time you put in to doing it correctly, the easier it becomes, the slower the market is. So this spreadsheet is designed to help you get over that learning hump as soon as possible. The first tab in this 4-tab spreadsheet is what it looks like to have your rules met. So in the green, strong triggers, clear path, entry. That's your rules being met. Learn them individually. So I'm going to give you something, and you're going to be able to take pictures. And you're going to take a picture, and you're going to say, hey, check it out. This is a strong trigger, and here's why, and here's what rule is met. And over time, you're going to get this down. This will take you an hour or two. And then you're going to focus on making sure that there's no termination conditions. And that's going to take a little bit. And then you're going to learn how to define your entries. And what you're going to do is you're simply just going to piece these together, and you're going to begin to recognize the pattern that they create. And that's your path to success. So following rules, guys, I can't stress how important that is. No, I'm not. Is it breaking up again? It might not be me. In the red section is what it looks like to not have your rules met. Do you guys need me to do a reboot, maybe? I can. If you're struggling to hear me, I can definitely reboot. It looks like on my YouTube stuff it's picking up fine. Audio looks really good. So it may be Discord. Can you guys hear me? Sound? Anyone? No one? Oh, it is good now. Okay, cool. Guys, the opposite of strong is weak. This is rules met. This is rules not met. This is part of that 90%. This is the sit on your hands moment. The opposite of a clear path is a termination condition. This is your sit on the hands moment. This is the I don't have to be in a trade. My advantage is gone. And we focus heavily in this room, and you'll see why, on having strong triggers and insisting on a clear path. Because when you understand these two, That third section changes. That third section grows. Once you understand how to identify strong triggers and how to couple it with a clear path, you're going to find some pretty creative ways to get paid with the software. You're going to see it in this room all day long. The second tab, this is the client traits. This is where I very politely pilfer all of your hard work. When you post in my room and you say, hey, Mark, here's my trade, take a look at it. And your trade is amazing. It has momentum and the path is good or potential to break and your entry makes sense. Guys, I steal it and I drop it in here, and I've been filling this out for a long time. Um, there's about 500 pictures of Nexgen users using the software, finding success, both simulated and live. There's the entry sequence for longs and shorts. As you work on entries, guys, go through these individually. Learn the process to pinpoint where the market is most likely to continue. There's a very simple management plan that I've created. This will be included in the plan that I give you. And then there's ideas for when your chart reading can take you to that next level to find more profits. You'll begin to see patterns in the market that you recognize that repeat themselves. About once a month, twice a month, guys, I take a picture of the market because it happens. And let's see if I can find it. It's been a week, I think, since I've done it. But there is patterns that just repeat themselves. And it happens all the time. It happens on big charts. It happens on little charts. There it is right there. This is the S&P. I believe this week. The market goes up, comes down to the mid-band, retests, and that's where it reverses. There's crude oil in 2021. It's the exact same pattern. The trigger lines look almost identical. The divergence, the pivot stop out is there. And guys, this market did in fact reverse and go down. So everything we do is patterns. I love this picture because this is 4 years apart and they're still doing the same thing even in different markets. So you'll begin to see things. Take pictures of them, drop them in the room. Also, take your pictures and drop them in your trade plan. This is designed to give you a place to store your pictures as you do your study, as you take these trades. This one was perfect. Let's put it in here. This is going to be what I look for every day. This is my pattern. I'm working on management. Here's my pictures as I work on management. Patterns that I'm beginning to see. And guys, you can share all of these in the classroom to get feedback. And then finally, whoops, there's the trade tracking sheet. This is my favorite sheet on the whole thing because this is where, as you begin to start simulating and practicing, every trade that you take, you're going to drop in the room. And you're going to say, hey, Mark, this is what I did. This is what I saw. This is where I did it. Talk to me. And I will, guys. I'm not afraid to talk to you. I'm not afraid to tell you what you did great. And I'm definitely not afraid to tell you where you made a mistake. But the thing is I'm going to help you fix it. If you make a mistake, guys, I'm going to work with you. We're going to learn how to avoid it. So what you'll see is if you drop your pictures in here, and here's all of the how-tos, always address momentum and path. Whether you had it or not, always talk about it, because what's going to happen is over time, you're going to see that the more often you have two yeses, the more often you're doing good things with the software, the more often you're winning. Every trade that you take, I will give feedback. Fill it out in that feedback section. And you're going to start to see things. If you come back every morning and study the trades that you took yesterday, you're going to see what you did, how you did it, and then you're going to see what I had to say about it. And very often, you're going to see the same thing. Into a termination condition. Here's how to avoid it. Into a termination, into a termination. That's the Mark Novak story. I love to trade into termination conditions as a new user, and I had no idea I was doing it. I didn't put the study in on rule number 2. I thought I had a clear path. And it was from posting in the room, and it was John Novak that looked at my charts that finally said, dude, how many times are you going to trade into these lines and lose before you stop? And the answer was somewhere around 23 million. But I did finally stop. But I didn't even know I was doing it until I checked the feedback. So take your trades, accept the feedback, write it down, study it every morning. If you do that, you're going to set yourself up for the day, guys. You're going to be focusing on the things that are bringing you success. You're going to be focused on avoiding the things that seem to be taking that success. And I think the most important thing is you're going to begin to recognize patterns in yourself. You're going to see where you have a weakness, where you tend to break rules, where you get jumpy, where you can't seem to be patient. And it's all going to be defined in the feedback section. So every morning you have this clarity to trade just a little bit better than you did yesterday until you reach your goals. By the end of this hour, by the time I'm done flapping my gums, guys, you're going to have everything you need to be successful with the software. You're going to have a plan. You're going to have a study guide. You're going to have everything that you need for the highest probability trend trade that we could ever teach. The one thing that I can't give you is experience. The one thing that I can't give you is the desire to study, to post in the room, to go take those pictures. That's on you. But what you'll find is that the people that put the work in, the people that post in the room, the people that ask the questions, these are the men and women that are reaching their goals the fastest. So I encourage it. Flood the room if you need to. From 9 to 12, you're trading with a partner that has years of experience. Take advantage of it. I like it. Thank you, Ron. It's only 3 rules. Could you imagine starting college and they just said, hey guys, you have 3 things to learn, and then you'll have everything you need to go be successful in the workspace. That's what we're doing. And it starts with the large chart, the big chart, the slow chart. It's the large crowd, ladies and gentlemen. And they have to have strong trigger lines because my plan says I must have momentum before I ever look for rule number 2. Momentum is the easiest lesson of the day, guys. Momentum uses the trigger lines, small and large, and momentum is defined by the separation between the two. So when we're talking strong triggers, if the background is green, the market's going up. If it's red, it's going down. The only way I can have strong triggers is if the colors match. If my background is green, both large and small must be green. And if the background is red, both small and large must be red. Guys, strong triggers means that the smalls are above and away from the large are wide, they're angled in the direction of the trend, and it is this space that's created between the triggers. It's that gap between the two, and you guys know what's coming. It looks like scissors that's open. And when the scissors are open, these guys can cut you a check. Jerry, I'm stealing it. Because open scissors, separation, guys, that's strong triggers. When I have strong triggers, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum. This should excite you. When you see strong triggers, you should start chomping at the bit. Man, this is awesome. Because this is the advantage that pushes the market. This is the advantage that can break key Fibonacci areas. Guys, this will even cover some of the mistakes that we tend to make as new users. But momentum is not a forever advantage. Eventually, the scissors close. Small triggers work their way back inside of the large triggers. And guys, when your smalls are inside of the large, this is a weakening of the triggers. Weak is the opposite of strong. It should spark this reaction that, oh my gosh, my advantage is gone. And when I have weak triggers, guys, anything can happen up or down. The odds are no longer favorable for the market to continue in the direction of the trend. This is where you see the market kind of reverse from the middle of nowhere. This is where you see key Fibonacci areas. They're more likely to hold, guys. Bigger retracements, deeper pushes. So strength, weakness, odds favorable, anything can happen. And guys, it happens all day long. Let's open up a large chart and see where we're at. Strong triggers push the market up. As they get weak, look at the retracement. Pretty cool, right? Strong triggers breaks a couple areas. As they get weak, there's your retracement. Strong triggers pushes the market down. When they get weak, there's your retracement. I mean, come on. Strong triggers pushes the market up. They get weak right at a Fibonacci area. That was your top in the market, guys. Weak triggers. Can you give me a why if you're with me? It's not hard to recognize as long as you remember that the scissors have to be open. This is your look. This is where the advantage lies. This is where we're going to go to rule number 2. And then that's your weakness. 4 out of 5 times the market reverses with weak triggers. And this is even without the benefit of Fibonacci. Learn the difference between the two. Commit to the advantage of momentum. And once you have it, we got to make sure there's nothing in the way. As a clear path. I'm going to say it again. When you have momentum and a clear path, you're going to see people capitalizing on this look all day long. And it's not going to be with high probability trend trades. They learned these concepts from the high probability trend trade, and then they created their own plan using those advantages. A clear path comes from not having any termination conditions, guys. No areas in the way likely to stop the market. Termination condition is a Fibonacci-based indicator that may reverse the market. Notice that May is a different color. It's underlined. One of the things that is a 100% absolute in day trading is that there are no 100% absolutes in day trading. You never know what's going to happen. So what you're going to do is you're going to say, hey, I've got a recipe, I've got a comparison that lets me know when that area is more likely to be trouble than not. Areas. We saw this picture. We're going to see it again. Horizontal lines on a large chart, on the big chart, on the slow chart. Horizontal lines on a large chart may reverse the market, guys. These are where the large crowd are making decisions. These are where buyers buy. These are where sellers sell. These are where fights happen. These are where reversals are most likely to come from. Divergence highs, divergence lows, Fibonacci resistance, support, one-to-ones. You know about these areas long before you get to them. And it's a pretty easy recipe to identify one as a termination condition. There's a skip in my sound. I prefer it to be in my step, honestly. Man, I keep pushing cords. I don't know that it's me. Let me unplug and replug. All right, there's the full rehook. Did that help? I did the unplug replug trick. That's what they tell you in tech support. It's only little bits and occasional. Didn't hurt. Right on. Guys, I want you to think of lines on the large chart as decision-making points. That's it. So in order for a decision to be made, you got to let the market get to the line. So the first step in identifying a termination condition is price reaches an area. And price reaching an area means that those dynamic Renko bars go up and reach that area of resistance, or they come down and they reach that area of support. And this is the easiest thing you could ever do. When price reaches an area, all you have to do is ask yourself, where are my triggers? If your trigger lines are below the area of resistance is a termination condition. Price reaches, triggers haven't broken, no more trades into the area. It could stop the market. It could create a bounce. There could be a fight. It could break. You'll never know. You'll never know what's going to happen. But more often than not, if price reaches the area and the triggers are below, it's going to create a problem that can pull you out of a trade. Price reaches support. Where are my triggers? My triggers, small and large, remain above support. Support is a termination condition. Rule number 2 says absolutely no trades into that area. These areas, guys, are amazing. This is what it looks like in the moment. If the market were trending up, price reaches support, or resistance, the triggers have not broken through. Absolutely no trades into the area. We don't know what's going to happen. It could do this the same way it did previously, or it could break. I don't have any idea. So absolutely no trades. And I want you to see just how effective Fibonacci can be. Price reaches Fibonacci resistance. The triggers don't break it. That's where the market reversed. Price reaches Fibonacci support. The triggers didn't break it. That's where the market reversed. You can see all this indecision right at the fibs. Decisions are being made at key areas. Those weak triggers can't push lower, and it comes right to resistance with all the triggers below it. And sure enough, it continues down. It retraces to resistance. The triggers don't break. Continues down, and even with odds favorable momentum, support stops that market. And now we are currently directly into Fibonacci support. We have an awful lot of momentum. But guys, this line is a termination condition for the moment, and every line you reach will be a termination condition, at least for a moment. Does that make sense, everybody? That's how you define a termination. This is the most broken rule, but this is probably the rule that keeps you out of avoidable losses the most, if you just learn to respect them. Areas break all the time. Markets reverse from areas. These are what are going to produce those clear paths that we're looking for. So if price reaches Fibonacci resistance, as it did right here, guys, you're in a holding pattern. You don't know what's going to happen. You're sitting on your hands, and you're saying, okay, it's either going to do this or it's going to do that. It's either going to break Voice not breaking, just think I have a schizophrenic voice. Very possible. Guys, if both your small and your large triggers get above that area is broken. It's in the rearview mirror. It no longer matters. Your trigger lines tell the story, not the price bars. So price reaches and I pump the brakes and I wait and I'm patient and I'm not doing anything because I don't know what the reaction is going to be. It takes almost 10 bars for the small and large to get above resistance. But when it happens, resistance becomes support. There's nothing in the way, guys. My path is clear all the way up to the next area. If I get to that area, I'm not trading directly into it. My rules aren't met. And sure enough, look at this. The market reverses, and then I get that odds favorable momentum. Guys, there's nothing in the way. My path remains clear until I reach the next area. So you can get a clear path from a breakout when Fibonacci areas break. You can end up with a clear path from a reversal. As long as you remember that when price hits an area, you've got to go back through those calculations. The easiest money you will ever make, the highest probability trades you will ever take with this software are when Rule 1 and Rule 2 are met, guys. When I have odds favorable momentum, when I have a clear path, this is where the easy money comes from. Those tails on a big chart, you're going to see them all day long. We're going to use them to study. Those tails, that's the pullback on the small chart. That's that refinement. You're going to be pinpointing right where the tops and bottom of those tails are most likely to form through rule number 3. We don't trade the tails. Our entries come from the small chart. But you can go back and study them. And what you'll see is that in between Fibonacci areas is where the money happens. It's the easiest. We had a guy in here yesterday put on an absolute clinic. He took trades from areas to areas, hit the brakes, and when they broke, he started up again, and he did it all day long. He said the market was like an ATM. So those are your options, guys. It can either be a termination condition, right? Or it can be a clear path. Let it be that black and white. Give it about 20 days of the best, and it'll open doors for more trades for you. Those are large chart terminations. Those are the ones on the big slow chart that let you know when there's nothing in the way. Those are the ones on the big slow chart that let you know that there's nothing there to create a bounce, that there's nothing there to create a ricochet. And man, when it turns, look at that, rules met. There's one of those tails, probably an entry for some of you to take the market up. Right now, we do have odds favorable momentum, and they're trying to get to the other side, but they haven't yet. We still don't have a clear path, not until the large triggers get below this Fibonacci area. There is one termination condition, excuse me, that is not on a large chart. This is, well, it is on a large chart, but you won't see it. It takes like an hour to form. You're going to see it on a small chart first. Guys, this is the only small chart termination condition, and it's 3 divergences in the same price range. Divergence is a loss of momentum, and what you're seeing is the buyers in control and the sellers in control, and the buyers say, nope, we're stealing your momentum, and they push up. And the sellers say, but we really want to go down, and the buyers say, nope, we're stealing your momentum and pushing up. And on the third time, this is where the buyers get upset. They're like, we told you twice. Here's your third divergence. Here's your loss of momentum. That market is likely to go the other way a little further. It can terminate a trend. Guys, 3 divergences in the same price range on a small chart is giving you the heads up. It's showing you the change that you can't see on this big slow chart. This chart is screaming down with all the momentum. All of this happens inside of that one bar, and it says, hey, no more short trades. That's the small chart showing you change on the large chart. If you see 3 divergences in the same price range on the large chart, that's when you can anticipate bigger moves the opposite direction. It's pretty impactful. All right, how was that? Momentum and path. We're there. You guys have your core. You have your foundation. Now you just need to study it a little bit. When the large chart has strong triggers, I have the advantage of momentum. And only when I have the advantage of momentum as a brand new user will I look for rule number 2. And rule number 2 says don't trade into a line, silly. That's where decisions are made. I need that clear path. So when I have momentum and path, guys, I'm going to go find an entry. I'm going to pinpoint where the market is most likely to continue, and the accuracy is pretty astounding. Um, I'm going to use a limit order. I'm going to wait for the market to come to me. And I'm going to use a limit order to buy or sell a pullback. And that pullback is just a retracement. I think the clinical definition of a retracement is a small move counter to the underlying trend, which means, let's find a picture of what a small move counter to the underlying trend means. When my large chart says up, strong, nothing in the way, my retracement is that little push down. This is the small crowd fight. Um, so we're going to use a limit order to buy or sell a pullback at areas, at Fibonacci areas, at mid bands, and at yellow one-to-ones. Because the same way areas on a large chart can stop a trend, areas on a small chart can create a bounce and resume the underlying trend. But here's the key. We need those areas to be inside of the trigger lines, guys, because triggers are going to define your retracement zone. One of the gospel truths is that when price accelerates away from large triggers, it tends to pull back to large triggers. And you see it over and over. Price goes away from the large triggers and it comes back to the large triggers. And it goes away from the large triggers and it comes back to the large triggers. So what you have on a smaller, faster chart is two sets of large triggers. Let me pull up my small chart. You have trigger lines that look like they have steps. These are called your synthetic triggers. Your synthetic triggers are just the large triggers from the large chart. And then you have the smoother triggers. These are your 5-1 triggers. And these are native to the 5-1. So what happens is if price returns to triggers, you can define where price is most likely to retrace by using those triggers. And watch this. If I just put the circle around the large triggers, you can see that they encompass the synthetics. And if I just put them around the 5-1 triggers, you can see where the market may retrace as well. So the tighter these triggers are on top of each other, the more accuracy you guys are going to have. Let's go through the entry sequence. When the large chart rules are met, when you have odds favorable momentum, when your path is clear, I can't stress that enough. You're going to turn your attention to the smaller, faster chart. Have a great day. Okay. And the market's going to be screaming up. And I'm going to be honest with you. You're going to have this fear, this dread, this, oh my gosh, I'm never going to get paid. It's going without me. But there's a pattern, guys. That's all it is. It's a pattern. It's a pattern that repeats itself. And it begins with a reversal bar. So a reversal bar means that after all of these green bars up, you get a red bar down. That's your reversal bar. The reversal bar isn't your entry. Oh, hey, good morning, Cap. The reversal bar says, hey, guess what? The fight is on. The retracement has begun. The pullback has started. You will be able to define where the retracement is most likely to go using the triggers, the large and the synthetic from the top to the bottom. And you're going to say to yourself, okay, this is where the market is most likely to retrace, somewhere between that reversal bar and the bottom of those triggers. That's a pretty big range, right? And then you're going to say, all right, the reversal bar happened. I know where the retracement's most likely to go, but trigger lines aren't bouncy. I need areas. I need fibs. I need mid bands. I need yellow one-to-ones, and they need to be inside of that retracement zone. So here we have the mid band, and we also have yellow one-to-ones. And that box, that's where the small crowd is most likely to fail, guys. That is where the bounce is most likely to happen. And the bounce could take place from the mid band, or the bounce could take place from the one-to-ones. You'll never know. So it creates a window. But because of the large chart advantages, because the large chart is up strong and there's nothing in the way, your job is to activate a limit order about 2 ticks above that highest point of support. And this becomes your entry. This becomes your entry for the high probability trend trade. And what you're going to find is once you learn this recipe, guys, you're going to be taking some sniper entries. And I'm going to show one from this morning. 2 ticks above support, the highest point of support inside of favorable large triggers. You're going to be taking these entries, and it's going to look like you have a crystal ball predicting where the market is most likely to bounce. And it takes a little nerve. It takes a little nerve to buy a market on its way down. You'll get there with a little bit of study. So reversal bar, define the retracement zone, define the areas likely to create a bounce. Your limit order goes in just above the highest point of support. Futures are amazing. We can make money both ways. So when the large chart is down, when the large chart has momentum, when the large chart has a clear path, once again, you're going to wait for the reversal bar. The reversal bar is not your entry, guys. This is letting you know that the pullback, that the fight, that the retracement has started. You're going to be able to know where that fight's most likely to go. That retracement from the bottom of the large to the top, somewhere in there is where price is most likely to retrace. But triggers aren't bouncy. They're not your entry. You're going to identify the areas within. Fibs, midbands, or yellow one-to-ones. And guys, there is one line inside of triggers, one area inside of triggers, and that is where the market is most likely to bounce. That is where the market is most likely to continue. And guys, your limit order is going to go 2 ticks below that area inside of triggers. I'll show you exactly what I do, Todd. Great question. So when we are entering the market, not we, there is no we, when you are looking to put a limit order in, let's say that you're waiting for resistance inside of triggers. Todd, you're going to be able to right click and sell limit to, and you're literally going to have a limit order waiting at the area. So it's not even ask or bid. It's not even using these buttons. So let me tighten this up and go like this. If I'm looking for a short trade, Todd, if I click anywhere above price, it's going to give me the option for a limit order. If I click anywhere below price, it's going to give me the option for a buy limit order. So if I'm looking for long trades, I'll have that buy limit order waiting right at support inside of favorable large triggers. If I'm looking for a short trade, I'll have that sell limit waiting right at the areas right inside of triggers. And just for grins, let's see if they get us here. We'll put it a tick below the mid band. I have momentum. It has the potential to break. I've defined where the market is most likely to continue, and I'll literally wait for them to come get me. And I know that they're coming for me at this reversal bar. So a lot of times you would already be in this trade. Does that make sense, Todd? So it's a limit order to get you in. It's pretty accurate. And I don't know if that's going to work or not, but we've got other things to talk about. And you want to be just below that area because remember, the large chart is screaming in the direction of the trade. We don't expect him to get too far. Any lines on the wrong side of triggers, guys, any lines above that retracement zone, any lines beyond the areas within the retracement zone, guys, these are where the advantage of rule number 3 is no longer in play. You're going to learn to ignore it. If there's Fibonacci support on the wrong side of the triggers, below those triggers for a long, or there's Fibonacci resistance one-to-ones above those triggers when you're looking for a short, guys, your advantage is gone. And once you get to the other side of that retracement zone, you don't know if, when, or where that market is going to stop. So we're going to use that concept by defining where the market is most likely to continue. You have defined where the market should not go. This is where your initial stops are placed. Generally 4 to 5 ticks above all the trigger lines, guys. Generally 4 to 5 ticks below all the trigger lines. And you're going to say to yourself, man, this is my pattern. I have momentum. My path is clean. I've defined where the market is most likely to continue. If they can push past that amazing entry, I don't want to be in the trade anymore. My advantage is gone. And my life revolves around having advantages. And you will take a loser here, guys. And I'm going to tell you, anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. It's okay. It's a cost of doing business. But the idea is that you take the correct losers, if that makes sense. There are good losers. Good losers have momentum. Good losers have a clear path. Good losers have a clearly defined entry area. I'll lose one of these all day long because I know I'm going to lose 2 or 3 out of every 10. The idea is to not take avoidable losses, to not sacrifice your advantages and trade on hope. because when these great trades work, it's no fun when they have to make up for the mistakes. So learn a little commitment, adherence to rules, and then here's your pattern. This is everything together. Strong triggers, you have the path, and you can see that there was a tail. Guys, this tail is after the fact. If you circle these tails on your large chart when the rules are met, go see if they line up with an area of support inside of favorable large triggers. Go see if they line up with an area of resistance inside of favorable large triggers. If it does, that's your pattern. So you don't even have to take trades to learn this pattern. Look at that. There's all that great momentum. These areas have the potential to break. It pulled right back to resistance inside of triggers. And guys, that momentum is dropping like a brick. Anybody in this trade? I sure hope so, because that's a good one, isn't it? That's a beautiful trade. Guys, this is your pattern happening live in the market right in front of you. You can scroll back on that large chart you were in, Bob. I like it. Let's look for momentum and path. Let's circle a tail and see if it fits the rules. It doesn't mean that it did fit the rules, but if I scroll back on my small chart, pulled right back to support inside of the retracement zone, off it goes with all the momentum. This one was directly into a termination condition. I'm not going to circle the tail because my rules aren't met. There's a red fib there, David, right here, right here. Let's talk about it. Whoops. Large chart or small chart, David? Which one has you scared? We're going to talk about a look. Small. So let's start with this. Where do termination conditions get defined? Let's go through the 3 rules. David, you're going to love this. Do I have strong triggers? What do you think? And we're talking about this bar where the trade occurred. Smalls below large? Absolutely. So I have the advantage of momentum. Do I have a clear path? And guys, this is a lesson that we haven't talked about yet today, but we talk about it every day. We know that a clear path happens when both small and large triggers get below the area of support. That's when the area of support behaves as resistance. What we have here, ladies and gentlemen, is what we call, whoops, I guess we can use that one, huh? This is a 50-50 trade, and what it means is that 50% of my triggers have gotten through that area with momentum. But 50% of my triggers, the large, are still above. What this look means to me is that this fib has the potential to break based on the momentum. Guys, this is the second trade in the plan that I'm going to give you. This is the trade that is dependent on you recognizing that the small triggers are through, the large are not. So the termination condition started right here. That's no trade. Once the smalls get through and the large are almost through and we have all this momentum, this fib has the potential to break. Does that make sense, David? So the large chart says you have strength, whoops, but the path isn't clear yet, but has potential. Go to small chart and make sure it's perfect. And what is perfect on the small chart? Well, I need momentum to break areas, David. Does that make sense? It's that strength that pushes me through. I have it on the large chart. I want to make sure that my small chart's not telling me that it's going away. So I have strong triggers on the small chart. Smalls are outside of the large. I love that. I don't have divergence on the small chart. There's nothing saying that this market is slowing down. There's my pullback. So let's go through the entry sequence together. Let's get rid of this cheater circle. Large chart says strong. Large chart says potential to break. Is everybody with me on that? The fib's still blue, right? Whatever. But I've got all of this momentum and the potential to break. That's what we're looking at. So if we're going to look for an entry, we're going to head over to the small chart. We're going to assume that you guys missed the momentum trade. And we wait for the reversal bar. And there it is. At the time of the reversal bar, I say to myself, the market is most likely to retrace somewhere from the bottom of those triggers to the top of the triggers. And I don't know where. I don't know if it's going to go to the mid band, beyond the mid band, if it's going to stop right here. So what I'm going to do is I'm going to say, okay, this is where the retracement is most likely to happen. Are you guys with me? And the role of these areas, the role of the fibs here, it's okay to have a red fib, David, because we're not trading up. What we're doing is we're saying these areas of resistance, 2 fibs, a mid-band, and yellow 1-to-1s, one of these is probably going to create a bounce. One of these is probably going to ricochet and help that market continue down with a large chart. Your job is going to be to activate a limit order just below the lowest level. And what happens is you're saying to yourself, it could go from here. It might go from here. I don't know. But with this much momentum, I'm going to get in down here. And it comes up, and there's your entry. You're in at 47. And here's the part that takes a little bit of faith in the methodology. It continues up, but it's still in the retracement zone. And it continues up right to the area a tick below the midband inside of triggers. And then it heads down. And guys, now the market's heading in the direction of your trade. And it waffles a little bit. And then sure enough, the large chart wins. So you're going through this process. These Fibonacci areas inside of triggers, David, these are areas that are going to help create the bounce down. Whoops, I did that wrong. On a large chart, these could create a bounce up. Once you get below them, we're looking to use Fibonacci to create the bounce down. Does that make sense? So what was a potential termination condition on the large chart, when it breaks or has the potential to break, that same area can create a ricochet down. And what happens is if you use the language, and if you're very consistent with the language, when my large chart rules are met, I'm going to buy or sell a pullback at an area inside of triggers. There's my pullback, there's my areas inside of triggers, and then there's the bounce down. And David, I want you to see where that yellow box ends up on the large chart, right on the tip of that tail. And sure enough, down it goes. Pretty cool, right? Guys, this is your pattern. This is the pattern that typically wins more than it loses. So one of the things that's going to be important for you guys is I mean, aside from learning the rules and knowing the advantages, make sure you know where to find them. Because one of the things that happens a lot is people let small charts talk them out of trades. People let trigger lines changing color on the small chart talk them out of trades. They say, oh my gosh, I hit a 1-to-1, or it's not all the way through, and they let them talk them out of trades. So know where your rules are met. Know where those advantages come from. Know that this is just an entry chart and a way to manage. And what happens is these aren't scary, these are exciting, because these are where the market was most likely to continue down. And if you look at it, there it is. On our most current bar, do you guys see how the smalls are inside of the large? I want to go over how rules are designed to keep you safe. So will you guys humor me and play along? On the most current bar, do I have strong triggers? What do you guys think? Smalls are inside of the large. Everything's red. Bob says no. Bob, I'm inclined to agree with you. Do I have a clear path? Absolutely. So right now, I've got 50% of my advantages on a large chart, right? I've got 50% of them. I don't have momentum, but I do have a clear path. So let me write the rules for rule number 3. Rule number 3 says pull back at an area inside of triggers. Well, there was my reversal bar. Here were my triggers. Here's my area. Is rule number 3 met? What do you guys think? Do I have an area inside of triggers? No, Bob. That's crap. No, there are no areas inside of triggers, Bob. So if all I do is talk to myself about my rules, instead of hoping for a short, hoping for a long, I'm missing 66, I can't type, percent of my advantages. I'm missing momentum. I don't have an area inside of triggers. Guys, I don't have what I need to take a high probability trend trade. I don't have what I need to feel like I have enough of an edge to want to activate a limit order and enter that market. Does that make sense, everybody? All I did is I talked about these 3 things. And when 2 of them are missing, I have absolutely no desire to be in a trade. If 1 of them are missing, I can insist on the other 2. I can call it a medium probability trade, and I can manage it a little more aggressively. We'll come back to that and see what happened. I am going to give you guys the keys to the kingdom. Chart reading 101. I promised you everything you need. I'm about to give it to you. And I'm going to drop this zip file in the room. It's called All You Need. Chart reading 101 is designed to keep you focused on the large chart advantages, guys. So chart reading 101 is going to have you take 25 pictures each. Take pictures of strong triggers, weak triggers, clear path, termination. Know the difference between the two, because once you can identify momentum and path, you have what you need to build your own plan that makes sense, that wins more than it loses, that is consistent. Take these pictures, annotate. Write on the pictures, guys. So don't just take a picture and say, oh, look, I took a picture of strong triggers. Go through every time you take a picture. Let me get this up for you. And say, okay, the smalls are below the large. My colors match. My scissors open. This is strong. Odds favorable momentum. And what you can do is you're going to say, every time I see this, I think that. Every time I see this, I think that. And you're going to create that little correlation between the brain and what it means to you, between the brain and the eyes. So go through that. Take those pictures, guys. Fill out your spreadsheet. Study it a little bit until it becomes second nature. And then the high probability trend trade, this is designed to give you the cheat sheet. This is a checklist for the best of the best, highest probability way to take a trade. And it comes from a strong top or bottom, which means that you have a termination condition that absolutely wasn't violated by the triggers. And then it reversed the market. It's a strong top. That's the precursor. There's your termination. Triggers didn't break through. When it reverses, it's a strong bottom. And some people will say, but Mark, the small triggers got through. And I'm going to bring Morgan's awesome picture. I want you guys, when you're talking about triggers breaking an area, I want you to think of a car trying to break through a brick wall. Let's zoom this up a little. Trigger lines have 2 lines. This is the front of your car going through resistance. The back of your car hasn't made it. This car has not made it through the wall. The triggers aren't through yet, guys. So if they don't get through and reverse the market, it's a strong top or bottom. Go back to 200. Precursor, not mandatory, not one of the 3 rules. The rules are, do you have momentum? If it's a yes, do you have a clear path? If it's a yes, define your entry. Guys, this shows you the parts broken down individually. It also gives you the trend trade checklist that says, hey, this is what you're looking for. Be sure to mark yes. And if you can mark yes truthfully to all 4 of these, guess what? Nobody's ever done worse than 70% with this checklist. So use this to police yourself. Use these to write on your chart to make sure that you're trying to follow those rules, adhere to the plan. And this checklist is the core of the plan that you're being given. This is the KISS plan. And the KISS plan is a stepping stone in your learning journey. And the KISS plan, is designed to optimize your chances of success with the high probability trend trade. And the KISS plan, guys, through simulation study, class feedback, continuous practice, you'll be able to make your own plan. It'll be based on your ability to read the indicators, but the KISS plan teaches you to read your indicators. And there's two things you have to know to find some success in this arena. You have to know why you'll enter a trade. That's because your rules are met. It's the easiest answer ever. If my rules are met, my rules describe a pattern that has been proven to win more than it loses. And if I study it, if I back test it, if I circle tails, if I learn to believe it, guys, I'll never avoid an entry in a high probability trend trade because I know that it's probably going to win 70 to 80% of the time. And I know that it's probably going to lose 20 to 30% of the time. I don't get to pick my winners and losers. The only thing I'll ever be in control of is whether or not my rules are met. This actually helps remove a lot of the emotion from trading. When you know that a loss is possible, you don't put that pressure of wins on. You put that pressure of execution of the method. Why will I exit? I'll exit because I lost my advantages. That's it. Or because I hit profit targets. So if one of my advantages is momentum, well, if momentum goes away, it's okay to exit a trade. If I can't trade into a termination condition, when I reach a termination condition, I can exit a trade. If my advantage is an area inside of favorable large triggers, when I go 4 to 5 ticks beyond those triggers, it's okay to exit a trade. Sometimes your exits produce losses, sometimes they produce small wins, but what happens is you're being very mechanical about why you will enter, and then you have to be very mechanical about why you will exit, guys. And the management for the KISS plan, it's clearly defined. I'm going to show you the pictures. It is designed to do two things. It's a two-contract trade. It's going to help you understand stop placement, putting your stops where the market should not go. You're going to learn to embrace that phrase, but it's also focused on getting you paid, making sure that you're comfortable pulling money out of the market. Guys, the market gives what the market gives, and you never know when they're going to change their minds. So getting paid is an important part of learning to trade. This is going to help you do that. And it's 100% dependent on entering where the market is most likely to continue. Because if your entry is 2 ticks below resistance inside of favorable large triggers, then your stop is 4 to 5 ticks above the triggers. And that's it. There's nothing to do. Sit on your hands. You've put your stop where the market should not go. You've entered the market where the market is most likely to continue. You know your risk before you ever enter a trade. And your targets are predefined at $100 and $200. So once you get your entry, guys, nothing to do. Sit on your hands. You're either going to get stopped out, or more often than that, you're going to get a reversal bar in the direction of your trade. Once you get this reversal bar, you're going to redefine where the market should not go. And your new stop is 2 ticks above that reversal bar. And this reversal bar reduces your risk from $150 per contract to $30 per contract. And we call a reversal bar, when the rules are met, a confirmation bar. This bar is confirming that the market is going down with trend, with momentum, with clear path, and from the area where it was most likely to go down from. It doesn't guarantee a winner, but it means you take a much smaller loser if things don't work out. Again, more often than not, with all those advantages, it's going to go to your first target. Your first target is $100 away from your amazing entry, and when you reach it, a contract is pulled off, the money goes into your account, and you're going to move your stop to break even to protect yourself. You're not putting your stop where the market should not go because you're still at an area inside of triggers with all those advantages. What you're doing is you're taking the stress of the trade off. You now have nothing to lose, and you're learning to trust that the large chart is more likely to push you to $200 than it is to come stop you out. And if it does, guess what? That's a $300 trade. And it's not a $300 day, it's a $300 trade. These trades typically take 2 to 3 minutes, guys. That's the money. That's the easy stuff, guys. So we've spent an entire hour learning to recognize momentum, learning to begin to understand path, and understanding that the easiest trades you ever take are going to happen in between Fibonacci areas rather than in 2 Fibonacci areas. So I've given you everything I know how to give. I have given you the rules. We've broken them down individually, what they mean to you, how to identify them, and a way to study them. You guys all have the ability to simulate to post in the room. A lot of you have been doing that. That's the second half of class. We'll look at your great pictures. The goal is that you're practicing the correct rules, guys. One of the things that happens is as a new user, we look at the money, not the process. And if I make $10,000 on Sim, I think I'm a pretty good trader. I must be doing something right because there's no way I could ever do that with luck, right? Guys, that luck runs out. That short-term victory typically turns into long-term failure. It resulted in about $5,000 worth of losses for me over the course of a couple hours. So make sure you're practicing the right rules. Keep it simple. Keep it focused. Learn the very basics. Be able to identify those core advantages, momentum, and path. You're going to find more opportunity, guys. You have everything you need to be successful. The only thing now is get the reps in. Take the pictures, ask for the feedback, practice, 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 commit to rule adherence, and you're going to end up where you want to be. Most people do. If you're not, you got to look at following the rules. You got to look at why you're not finding success. That's where posting in the room becomes so important, guys. So that's what the second half is going to be. Every trade in the room, your commitment is to tell me what you see. My commitment is to tell you if you saw it correctly. That's how the room works. I love seeing your wins, guys, but if your wins are low probability, a result of luck, we're going to talk about it. And I'm going to say, all right, you got them this time. Good job. But they're going to wait for you to go live and probably shut you down pretty quick. So when we get into the second hour, that's what we're going to do. Inside of that zip file I gave you is everything, including the PowerPoint that I used to teach. And guys, maybe for those of you that are like, well, there was a mid-band, Mark. Weak triggers, no areas inside. Look what the market did. We knew that was more likely to happen than not. We knew that it was more likely to happen than not. If you took the trade, I hope you managed it aggressively with only one of your advantages. Bob, are we high-fiving? For the last hour. And remember, guys, avoidable losses. This is a rules-based win. Easy money. This is an avoidable loss. Know the difference between the two. Commit to the easy stuff. Life doesn't have to be difficult as a day trader. I'll be back in about 5 minutes. If you guys need anything, post it in the room. If you have a question, post it in the room. If you have a comment, post it in the room. I'll be back in a few, and we'll get into all these great chart reads. Go stretch your legs, guys. To the second half of class. Good stuff, man. Is it just me? I mean, just help me out here. No long trades, right? Avoidable loser. No momentum. Avoidable loser. Excuse me, my goodness. That was horrible. Do you guys see it? Do you remember when I said 90%? 90% of your day is doing nothing, guys. 90% of your day is relaxing. 90% of your day is waiting. 90% of your day is insisting on advantages. We have defined those advantages, guys. You've got to learn them. You've got to learn to commit to them. So, good stuff. We're going to get going on the day. I'm going to start looking at pictures. We're going to see where we're at. I believe Miss Jen got us going this morning, and Miss Jen says, check it out, Mark. When I have odds favorable momentum, when there is absolutely nothing in the way, momentum is screaming. She's like, I'm just going to jump in and ride the wave, and I'm going to make some money. And Jen, this is absolutely beautiful. There's nothing in the way. The market is screaming, and you say, when everything is rocketing to space, I can just jump on in. I can just jump on in. Strong top to market reversal to odds favorable to 50-50. I like the way that sounds. You're feeling the market today, Wayne? Low stress, following rules? That's a good day. When you're in sync with the market, man. That was Pete yesterday. Pete was ridiculous yesterday. I think he was trying to lose and couldn't lose yesterday. It was pretty awesome. Jen, beautiful trade. Great use of momentum. Andy, not the 2004 trade. Whoops. And guys, this is TradingView. Andy, the 2004 trade would be coming from a termination and then buying that pullback to the small triggers up. So that's your 2004 trade. What you have here is a mid-band, and you're just hoping the mid-band holds here. I like the patience coming through. You're letting it roll, but it's not a technical HVA trade. What you did find, and I like this, is Andy, this held, right? Hit the mid band, and you're like, ooh, that could create a bounce. But I'm not just going to jump in. I'm going to force my small chart to get the small triggers below the large. It's going to be fast. Andy, I don't know what these triggers are. I don't know why you have 13 indicators on this chart. You're collecting here. But what you did is you recognized a pattern that is awesome when you have odds favorable momentum, and it's the market coming up and then working back down. This little up down pattern is what you got a hold of, and it was beautiful. It was really well done. But you sure have a lot of information on this chart that maybe you don't need. They're not the droids I'm looking for. I don't even, okay. As long as they do something for you, that's great. Nice trade, Andy. Some of you will keep it simple. Some of you will add stuff. Everybody's different. That's the cool thing. Everybody's different. Not everybody sees things the same. Not everybody processes the same. Jen says, check it out. I'm losing momentum. I hit a termination. Life is weird. I don't want anything to do with this trade. And she chooses not to trade. Great job, Jen. All right, Pete, we've got 4 of them. Let's catch all 4 of them here. Andy, let me show you. Yeah, definitely too many minds. Let me help you out here, and let me pull down my indicators, and I'll give you the picture. This is the textbook setup. This is the Nexgen setup. You could just go to the site and get them and download Nexgens, or you could try to build them yourself. Me personally, I've got direct access to John Novak and all his amazingness. And in this document right here, he has every workspace you need. Too many minds for sure. I'm just not that smart. But do what works for you, man. Do what works for you. Pete says, check it out, everybody. Strong triggers, room in between the fibs. Let me get paid in between the fibs with momentum. Momentum and nothing in the way. This is the Pete story. And then Pete, this is where it gets a little wonky. You're like, okay, it's got the potential to break. I'm getting above. And he gets in. He's like, oh, man, I hope it goes. It didn't. We'll see. Nope, I'm not going to hope. It's only potential. Divergences are printing. Let me get the heck out. I'll take a little 3-tick hickey. And that's no big deal, guys. That's beautiful management. It had the potential to break the same way it did here. Same look. This one didn't work. This one did. Sometimes you're the boot. Some days you're the butt. Everything says up. Strong trending market. He jumps in. Gets paid. Half off at 10. Trailing stop. Once again, with the market screaming and nothing in the way, getting paid is rarely a difficult endeavor. And then Pete, this is hard because I can't see the large chart. I know you're not coming from an area, but your 1 minute chart, it looks like, is showing you right there at 35 where you get in. Your 1 minute chart has already changed direction, given momentum, and produced an HVA. This is a great use of using two different time frames. This market says, hey, we're likely to push down. You just took it on NinjaTrader. We're able to capitalize. Pretty cool. I like the way you used both TradingView and NinjaTrader. I do that a lot. I'll take trades on NinjaTrader, but I'll use my TradingView charts as well. It's a lot of fun. Better Dad, I don't think, is back yet. Guys, if you excuse yourself from the room and you come back, let me know you're back so that I don't skip your charts. And this is nice. Remember that 3 divergences can terminate a trend? Weak triggers can push higher. Pete took his chart reading and turned it into a pretty awesome trade here. He let his small triggers get above the large triggers. Everything's above the synthetic triggers. And guys, that's just a little momentum snap and runs it right up. And Pete, that's cool. That's like, well, it's not a termination, but it's weakness. My small chart is compounding the weakness. I'm seeing change. Let me see if I can capitalize on that momentum. And you did it really well. Kind of unorthodox. Definitely not a high probability trend trade. But really great execution coming in. Nice job, dude. All right, here comes the Wayne show. 1, 2, 3, 4. Let me do this. Nope. 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 All right, here we go. Wayne, that's a lot of arrows, man. You're covering up what I'm looking at. Let's see what we have. Strong trending market. I love it. Jump the fudge in. I like it. So it's hard to see what's going on. I'm not going to lie. Because I can't see prices here. I'm looking at all of this, but it looks like you're getting in down here. And it's tough to figure out what the heck's going on. Down here, you do have a strong trending market, but you don't have a clear path, and that divergence low creates some struggles, and it pulls right back to the fibs. So this one doesn't work. Trying to take a jump in. Guys, if you're gonna jump in based on momentum, make sure you have momentum. That's a big part of it. And then the buyers try to push, and when they fail, you get in. You're able to make money. And then you jump back in again, and you're able to make money. And boy, you sure held that one a long time. Entered on the way down for the pullback to the large triggers. 2 off at 110. Stopped out for a $100 loss moving fast. Yeah, if you're just jumping the fudge in, Wayne, no reason to leave $200 worth of risk on it. Because, guys, momentum dies. Those pushes, when you're just trying to take advantage of a quick push, let it be a quick push. Base hits pay bills. Previous pick, disregard. So Wayne says, check it out. If price reaches areas and the large triggers are a full bar away, patterns tell me that it's more likely to close that gap, even more so if it's from a bad bottom. So Wayne, you let it get up to the edge. And I think that's the key to success on this one. You get to the very edge, to the highest point of resistance, and then when it begins to turn, you find a way to close the gap back to those triggers. Really nicely done here, Wayne. And guys, this looks counter trend and it looks like it's fighting momentum, but this is a pattern. This is a pattern that Wayne's recognized through study, that when price accelerates away from those large triggers, this is why we find great entries. They tend to pull back to the large triggers. And look at that. He just, boom, little snippet right there. Nicely done, Wayne. Wrong time index. All right. So the gap, you got it. And then hit buy market by mistake instead of sell. I've done that one before. So little mistake, it happens. And then Wayne, once again, if you're going to jump in, guys, this is for you just jumping the fudge in, people, this is the best lesson I could ever give you. If I get in right here and the only thing that gets me in is momentum, and guys, when you're just jumping in, momentum is the reason to jump in for you guys. Loss of momentum is a reason to exit. And if you're working on a management plan, I can't stress this enough. This reversal bar close on the wrong side of the triggers, that's your loss of momentum. This is a $20 loss, not a $270 loss. Right on. And where did you get out? Just below resistance inside the triggers, right? Yeah. I don't think there's anything wrong with jumping in, Wayne. I think you guys that are jumping in, most of you are doing it awesome. But the problem, and I think that the thought process, I'm not going to say the problem, but the thought process has to be, if I'm only using momentum to jump in, right? That's what it is. And it's not a clear path because your large triggers aren't below that divergence. That hadn't broken. Your path isn't clear. If all I'm going to do is jump the fudge in, I have to be willing to exit if that momentum goes away. And what happens is it's going to cut your losses dramatically. Well, I would think so. What do lines do? Lines create bounces, don't they? Whether it's the large chart or the small chart, lines create bounces. And Wayne, this might be a good visual for you. Check this out. Let me find a good example of it. I like this. We're going to have a cool little lesson. Guys, I love these visuals. These are things that I stumble into. So Wayne, when it gets to this area, that tail means that there was a big bounce on the small chart. As it dissects this area, there's the bounce. As it's going up, there's the bounce off of that fib. When it gets these fibs, there's a tail, there's a tail, there's a tail, there's a reversal. And this is that awesome idea that decisions and fights happen at these fibs. So if I just want to jump in, I want to be away from those areas. And the idea is I want price to get away from those areas. I want price bars to clear it. And this is your range. Getting away from the decision-making process, trading to the decision-making process. And that's what's going to help you find that success. And I think the way you're doing it as well, what you're doing is with that momentum, Wayne, because this is crazy strong momentum. And this is awesome momentum. The second half of that has to be, if momentum gets me in, it makes sense that a loss of momentum gets me out. How do I define a loss of momentum? I define a loss of momentum on the small chart as that close on the wrong side of the triggers. Because what happens is, whoops, I'm in the wrong one. Hold on. Whoops. I'm going to my pictures. We're pulling out the pictures, guys. As long as you're on that left side of the triggers, that market's going down, Wayne. You can see it in your picture. As long as they were left of it, that market didn't do anything. But once you get a close on the wrong side, that's where it started the other direction. And probably not coincidence that it continued up without a close on the wrong side of the triggers. So one of the things you can do is you can say to yourself, all right, if I jump the fudge in here, that's my exit. It doesn't mean that it's the end of the day. I've still got momentum. I'll jump in here. There's my exit. Does that make sense, Wayne? And I think that's what's missing from your jump in trades. In my professional, which isn't really professional opinion, is the willingness to exit when momentum goes away. Your advantage is gone. I like the entry. Love everything about it. I hope that made sense. 50-50, odds favorable momentum. There's a short against everything that didn't work. I'm not sure if we're talking about that one. And then once everything starts going up, it looks like you got in momentum out before the momentum is gone. Everything is up. Potential to break, you get in. Stops in the right spot, doesn't get you. And as it heads up, you get paid. Divergence on the 50-50, you exit the trade. Really nicely done on this one. Great management, great stop placement. It all makes sense. Divergence on a 50-50 is pretty horrible. 2 divergences on a 50-50, what a great reason to exit. Nicely done, Wayne. That's a true chili dog. Back of the bar clears the fib. You jump in. Your momentum trade fails. Do you see it, Wayne? It turns into a trend trade, and then it goes down, and there you go. So we're going to open the door for another great lesson. If I name my trade, no matter what you guys are calling it, trend trade, medium probability trend trade, momentum trade, chili dog, whatever it is, you know what gets you in, the advantages. Know the expectation. What gets me out? Because every trade has a different reason to get out. So your chili dog trade, if all you're relying on is momentum, a loss of momentum is okay. That's a good reason to get out. But what happened is your chili dog trade turned into a trend trade, Wayne, which means that when the market pulled back to an area inside of favorable large triggers with all that momentum, the expectation changes. The expectation changes dramatically. Now with all that momentum, I'm looking for the next key area. I'm not getting caught up in these little fluctuations. And one of the things that I notice, because my brain is designed to notice these things, is you're willing to hold through all of this into the trend trade. But once the trend trade forms and is going full rock star, you get super tight on your management. So it's curious that all of this keeps you in, but that takes you out. And you know it's pretty aggressive, right? So a little bit of management work, I think. Your entries are great. Your concepts are awesome. Your abilities are beautiful. All the momentum turns into, you get in at the high tick, turns into the trend trade, easy peasy. When momentum trades fail and everything is perfect, very often they turn into trend trades. You know that. So you either have to exit with the loss of momentum, take your hickey, get back in, or you have to be willing to put a ton of risk on it and hope that trend trade doesn't fail. I'm not sure what your plan is. Looks like you hold. Momentum down, clear path. I'm not sure what you missed there. That was close. Thought about taking this one, but momentum was leaving, so I didn't trade. See next pick. Same box on the previous pick. So a good lesson here, guys. Nobody's saying anything. I hope you can hear me. Bad top, mid band's your first place for a bounce. Just being aware, you did a good job with that one. And guys, when I have a bad top and I get back to that mid band, a lot of times I'm trying to get to that next key area. You did a good job with that one, Wayne. You saw that change coming on your range chart. One divergence. If you took that trade, that second higher divergence, good exit. Nice job, dude. Good chart reads there. Just jumping in. Momentum on 3 charts, it's pretty easy. When you have odds favorable momentum everywhere, it's pretty easy to find a way. And then there's that gap theory again. Price reaches a mid-band, large triggers a full bar away, close the gap. Good stuff, Wayne. Nice trading. Let me know if you have any questions about anything I said. All right, Pete. Someone told me once that money's made through management. I'm inclined to agree. A little early on this one. Large chart hadn't quite formed yet. Weak bottom, triggers rolling, clear path, and yep, you got in just a little bit early. You were trying to take that momentum run. That's okay. Pulls right back to the mid band, right at the triggers, and you run it up nice. And Andy, if you're looking, there's that pull back to the small triggers after the termination, and that's what it looks like. And nice trade, Pete. And guys, remember, it doesn't have to be your chart to ask a question. Bob, be the man. Weak top, hits a mid band, hits a fib, closes the gap to the large triggers. Now we get resistance. The triggers are below, down it goes. With everything cranking, you take the perfect entry, 2 ticks below those areas, and easy money, Bob. Easy money. And if I'm not mistaken, that's the same one that we circled and went through bar by bar in the classroom. So it's kind of cool when the stuff that I used to teach the room, you come back and somebody caught it live and made money on it. Really nicely done. Nicely done. Nicely done. Better Dad, let me get up and get to the 2 that I skipped on you because you were gone. So that we don't miss out. Boom. Boom. Let's talk about it. All right. Odds favorable. Clear path. So Better Dad, I'm going to show you before I even go through any further. This is one of the things that I see on charts a lot. Odds favorable momentum. Heck yeah. There's your trade though. Your trade is 15 bars later. So when you guys are annotating, this is definitely strong triggers. That would be a great study tool. What do you think about the triggers at the time of the trade? Just a little something. You're still outside. It's still good. But I see this sometimes where people go, man, that was a clear path. But their trade was all the way up here into a fib. So I like it. You do have the momentum still. The path is clear. There's room to the targets. Let's talk about this entry. Entered 2 ticks above the mid band. Marker buried in price. 99.25. Okay. It's just a weird look. So you were in 2 ticks above the mid band. You get out at the first sign of trouble and then get paid at the good stuff. Beautiful trade. That's a weird look, right? Because you were in at 99.25 right over here, which is perfect. Stop was perfect. Great first target. This is an awesome trade, Better Dad. Really nice. It printed funny, but boy, it followed the rules. When I looked at it the first time, of course, my first reaction is, why are you going long here and not here? And then I saw that too. So absolutely beautiful. All right, weak top, odds favorable, and it hadn't reached the midband, right? And you said keeping in mind the midband will operate as a termination condition. I took a picture for you and I dropped it in the room, but I want to show you exactly. Sorry. I want to share it because the midband, there we go, is a termination condition only if the triggers are a full bar away. But from a weak top, the mid band is very often a spot for a potential bounce. It's a testing zone, if you will, to see if the buyers want to continue up. And that was one of Wayne's pictures. Let me see if I can find it. When you have a weak top, well, Wayne, all yours didn't show. I'm going to take a guess and see if I get it right. Nope. Oh well. When I have a weak top, very often that mid-band can produce a bounce. You hadn't reached it yet, so you're looking awesome here. You've got everything down. You have momentum. You have a clear path. You have room to get to the bouncy point. It pulls right back to the mid-band inside of triggers. Since these weren't a full bar away, we don't know. It's not as likely to close the gap. You still knew where your stop went. Nothing changed in the weirdness. And it goes right to the mid-band. And it's awesome. It's a good-looking trade. But here's the cool thing, is your gap theory wasn't in play. Because do you remember that first phrase? That first phrase when identifying a termination condition. What has to happen, Better Dad? Price has to reach the area, right? Does everybody remember that? How do we define a termination condition? Price reaches the area. Price hadn't reached it. That's a target. That's a beautiful target. Has nothing to do with terminations yet. You had room, especially from the pullback. You had tons of room to get to it. Awesome. I love it, dude. This is such a good trade. What's your question about stops, Jared? This is a perfect opportunity in between pictures. Let me know how I can help you. Where do you put them? Great question. Let's do it this way. So I'm gonna say the one that is the pain in the ass answer first. Where the market shouldn't go. That's where we put stops. How do we define where the market shouldn't go? Well, Jared, it depends on the type of trade you're taking. Can we use, just for example, the high probability trend trade? Because as a brand new user, that's probably what you're focused on. Is that cool? So let's talk about it for a trend trade. Awesome. So with this up, with this strong, with all that clear path, let's talk about the entry rules. And this is going to help you. So the entry rules happen. Ooh, I think I have an even better picture. Here we go. This will be a good picture for you, Jared. So when the large chart rules are met, the first step in defining your entry is the reversal bar, because the reversal bar begins the pullback. And then it's the large and synthetic triggers from the bottom line to the top line. These define where the market is most likely to retrace. So when this reversal bar prints, Jared, what I can say is that market could retrace, it's likely to retrace, it may retrace all the way to the top line of those synthetic triggers. Does that make sense? At 63.16. Nope, so the top line of the triggers, let me take the box off so it's easier to see. The top line is right here, 63.26. The bottom line when the reversal bar prints is right here. And that is about 05, 63.05. So I've got about a 21 tick range where that retracement could go. Does that make sense? And that's all the triggers do for you, is they help you kind of define and understand where price may retrace. But the cool thing is, Jared, is it's not a 26 zone for entry. What you have is from the lowest point, from the lowest point of resistance to the highest point of resistance. So while the market may retrace somewhere between the bottom of the triggers to the top of the triggers, The market is most likely to bounce somewhere between that lowest point of resistance to the highest point of resistance. And that's where it's most likely to go down. Are you following me so far? Trigger lines will define where the market may retrace. Areas inside of triggers define where the market is most likely to bounce and continue. Here's the cool thing, is because you can define through the rules, this is where the market's most likely to bounce. This is where my advantage is. This is where rule number 3 is super rock solid strong. And even though these are most likely to create the bounce, I do know that the retracement could go all the way up to here. So Jared, when we talk about initial stop placement on a high probability trend trade, we're going to be 4 to 5 ticks above those trigger lines, because what you're saying is if the market is capable of pushing beyond the retracement zone, if the market is capable of getting past all those areas that could create a bounce, I don't want to be in it anymore. This is where the market should not go. And that's your initial stop for the highest probability trend trade. If you get a reversal bar in the direction of your trade and it goes down, and what this reversal bar is doing, Jared, is now it's telling you, Jared, we're going down with momentum. We're going down with a clear path. We're going down from the area where we're most likely to go down from. You can actually redefine where the market is no longer supposed to go if this is going to be a winner, and that's going to be your first stop movement. And if you go through the KISS management plan right here, this will actually walk you through it, Jared, step by step. It'll talk about where your initial stop goes, why it goes there. It'll show you your first stop movement in the high probability trend trade. It'll show you your second stop movement in a high probability trend trade. So on that KISS plan that I give you each and every day, the very mechanical management plan, exactly where to do it, if then, is all in place for you. And it just takes a little time to practice. That's all it is. Did that help? Was that too much? Sometimes I say too much. I fully realize that. Awesome. And it's going to be a little bit of practice, a little bit of repetition. Focus on your entries first. Entries make great trades. Jared, every plan is different. And what I do is probably not what you're going to do. Remember, I'm almost 6 years ahead of you. So yes, I do move stops to preserve profits. And let me show you what I'll do, and I'll show you how I'll do that. If hypothetically, let me see where the market's trading right now. If hypothetically I am in right here, I trade multiple contracts. If I'm in right here, I'm probably getting paid right here. I'm probably getting paid right here. And what I may say is, because I've made money in both of these spots, I'll put my stop behind this pivot and I'll say, okay, if that area decides to break, awesome. If that area doesn't break, I'll give a little bit back, and I'm comfortable with that. But I do that when I've already got $500 or $600 in the bank. I might risk 100 or so. What I won't do is I won't put it way up here and say, okay, I hope it goes, because I might as well just exit and get paid and wait for the next stop. What you'll do is you will come up with a management plan that suits you, and it's just going to be a byproduct of the time that you spend in the market, Jared. I'm a big fan of taking what the market gives, and to be honest with you, I rarely hope areas break. I get paid at the areas, and I understand fully that there's going to be another trade. There's always another trade. So I'd rather keep collecting money and wait for the next one instead of hoping the money comes to me, even though my indicators say it probably isn't. Great questions. Great questions. And Jared, everybody's got a different plan. That's the cool thing. is more often than they don't. That's how rule number 2 came into play. Rule number 2 says don't trade into an area, essentially is what it says. And Jared, it says that not because they don't break every now and then, but because when price reaches an area and the triggers can't break it, it holds more often than it doesn't. So if you're defining an edge, Jared, you would have to say that more often than not, these areas break. It's just not the case. More often than not, these areas create untradeable bounces or reversals. So even though every now and then they break, you don't have to hope that they break. You know where they are. You know they can create a bounce. You know that they can stop the market. Doesn't it make more sense if I'm in a long trade to simply get paid, right? Cutting out worse. Guys, I don't know what's going on. Is that better? I'm trying to push all my connections in. Is that better? Let me mute and let me unmute and see if maybe that helps. Every fifth or sixth word. That's weird. Hold on. Let me try a different port. Is that better? Can you guys hear me? Give me a Y if you can hear me. Nobody? Yes? Okay, so I'm trying to talk a little bit. I'm going to my microphone settings real quick. I'm just trying to figure it out. Thanks, Jared. I like that. Cool, cool, cool. I'm not sure what's going on. I'm going to have to assume it's Discord because I'm perfect. I don't know if you guys knew that or not. So it's probably Discord. Let me look at my microphone inputs and everything, make sure I'm good. Even over here, my microphone is showing me full tilt. Everything looks good. It may be Discord, and I apologize. But I like that you brought that question up. Because Jared, one of the things, if I take this long trade and I get paid right here, right? And I make $300, that's awesome. And then I take the next trade and I get paid right here and I make another $300, just getting paid at the area, no matter what happens next. And I take this trade here and I make another 300 here, and then maybe I find an opportunity and I exit here and I make 300 here. What's amazing is this is from 8:57 to 10:25, so from 9 to 10:30. So in 1.5 hours, in 1.5 hours, I make $1,200, and it's just getting in and getting out. And that's one of the wonderful things about what we do is you don't have to be in the market here. Whoops. You don't have to get in here and hold all the way here to have an amazing day. And you don't have to get in here and hold all the way to here to have an amazing day. The leverage and everything, God, it's just there's so much money to make in small moves. Yeah. So Jared, I might take an exit. So hypothetically, because that's all this is, right? If I get in here and I take it to this Fibonacci area right here, and I make that $300, that's a pretty good trade, wouldn't you agree? But then here, Jared, I don't get my rules met. And I don't make any money, but I also don't lose any money, hoping that things happen. And then I get another entry. Whoops. And I make $300 trading from above the fib to the next fib. And what happens, Jared, is you begin to realize the more you trust the software, is that it's okay to do nothing if you can't find advantages. What stinks is when you can't find the patience and you give $500 back, taking 2 or 3 trades when those advantages aren't there. And suddenly all of your amazingness results in $100 when it should have been 6. So right here, it would have been easy to lose money, right? And right here, there was the potential for the bounce. But right here, there was a perfect rules met trade. And there was a lot of money to be made there. And then nothing to do here, and nothing to do here, and nothing to do here. So we're waiting for the best of the best. And that's what we're doing is we're identifying when the market is telling us that we've got just the greatest advantages ever. And when those advantages come into play, wild horses can't keep me out of the market. Jen jumped the fudge in, but it turned into the trend trade. Jared, there's that same one, right? All the momentum with the potential to break. Jen jumps in. It doesn't work. Her momentum trade fails almost instantly. But it turns into the perfect rules met trend trade, and she gets paid beautifully. Your ATM strategy was wrong. You fixed it. Had 4 lots turned into a trend trade, did not add on. So you're in at 39 and out at 29. That's a $400 trade. That's a beautiful trade. If you're in at 49 at the trend trade, Jared, instead of 39, it's an $800 trade. Rules are designed to get the most out of the move. Great trade though, Jen. It's okay. The challenge is as a brand new user, if you're jumping in, you hold forever. And as an experienced user, you're a step ahead. No, do not apologize. Do not apologize. If the big trigger rolls outside of the little triggers, Jared, I'm going to put you on the spot here. Show me a picture of what you mean. I don't know what a big trigger rolling outside of the little trigger means. Awesome. Does it mean the trend is close? So Jared, now that it's coming together, I want you to fire that camera up. Right at the top of my, up here. So check this out. Let's do this. Let's take the noise off of it. Do you recognize that as strong triggers up? Absolutely. There's your first advantage, right? And then there's your weakness. So there's strong triggers, there's weak triggers. You are a rule number 1 expert. When the smalls work inside, what that weakness says is, hey, we're losing momentum. Hey, things are slowing down. And then Jared, if these large triggers roll from green to red, if these large triggers roll from red to green, that's when you can say, all right, we're probably headed the other direction. Your background's going to turn green before that happens, because what changes the color on the background is those small triggers starting to get below the large or starting to get above the large. And once that happens, you don't have momentum. So that's your transition area. And then once they all match again, that's that let's go find a trade time. Does that make sense? And what you're going to find is that you get these reversals all the time. Sometimes you'll get them right at key Fibonacci areas. Sometimes they'll come from the middle of nowhere. But these key Fibonacci areas, when you couple those with weak triggers, that's when they're more likely to hold. Fibonacci area holds. See how the triggers are flat, the area didn't break, and it actually reversed and went up. And then this is one of those looks where you have the potential to break. All the momentum is there. But it didn't really set up a very pretty trade for you. So that happens. Great questions. Man, keep them coming. Keep them coming, because the first couple days, Jared, you don't know what to ask. I know that you don't know what to ask. And now you're like, wait a minute. I've seen this. I've seen that. I know this. Let me get some clarity. And that's exactly what you're doing. And I'm telling you, if you don't stop doing this, you're going to get where you want to be. I believe that wholeheartedly. There's that same trend trade everybody took, guys. Missed the entry, didn't get you. So you jumped in and you caught the trend trade because you understand trend trade expectations. Really nice trade. Yeah, you've traded before, right, Jared? Yeah, so you know the trend is your friend, right? It's the oldest cliche ever, but it's so true. And the idea, Jared, I think is that if you force the large, it is cheesy, but man, if cheesy works, right? Cheesy burgers are delicious. If you let the large chart lead the way, if your large chart says the market's going down, if your large chart says it's going down strong, and if your large chart says, holy crap, there's nothing in the way or we have the potential to break, you've got a freight train to the downside. And then, Jared, all you have to do is learn that simple entry rule, because the correct entry for this trade, and I don't think anybody's shown me the correct entry yet. The correct entry for this trade, per the rules, 100%, without question, no hesitation, was 2 ticks below that mid band, right at 49. And then, Jared, with all of these advantages, once that reversal bar printed, you had $30 risk on this trade. This is what we talk about every day. So, are there a million opportunities in the market? You're darn right there are. There's so many ways to use this software and to use it effectively. But once you understand that core, once you can say to yourself, this market is pushing up, it's pushing up strong. I've got some areas that could create trouble. Let me clear them. You'll be amazed at what you're pulling off with this software. Good stuff. Better Dad. Not quite a strong bottom. It's close. Odds favorable momentum. Midband is not behaving as a termination condition. You take a beautiful entry, take profits, out break even. That's that KISS plan. And it's perfect. And then, Jared, do you see how he says his initial stop is here? Where the market shouldn't go? Absolutely. I haven't, Wayne. I haven't checked it here. Um, we're getting out of here today, guys. My guess is it's not crazy strong because I'm in a hotel. That's not bad, though. That's still pretty quick. Yeah, that's definitely good enough. So hopefully it's better when we get to the house later today. Um, Another great trade. I'm guessing it's Discord. I'm not going to lie. It's probably Discord. Every now and then Discord has challenges, and I haven't been able to work my way through those challenges yet. I haven't figured out how to fix them. Better Dad, did we talk about yours? We sure did. Beautiful trade, great management, following the KISS plan 100%. Rules adherence. Guys, when you tell me, no, Joel, I am in Southeast Washington. My wife and I started traveling again. It turns out our kids were doing amazing, and there's too much of the world to see. So she is the director of surgery about an hour, 45 minutes south of Spokane. And I'm just teaching from a hotel room right now. They put us in a suite in a hotel room, and we should have the house today. All right, market reversed out of nowhere. Everything is up with the potential to break. You just jump in, and it works out, and it's out there. When you have momentum on both charts and there's room between the fibs, you guys are going to find a way. Nice one, Pete. Da, 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 Andy, you're Andy. I need you to make your charts easier for me to read. Um, I love looking at your charts. but I don't have it like 2 bars. I can't discern anything. Bottom hit, a divergence, can't see any of it. Outer bands, towers of powers with long tail, into the red zone. I don't know what any of that means, brother. Oh yeah, Southeast Washington State, sorry. Bars printing on the correct side of the fast triggers. Bought a pullback, 25 ticks. On a 4 lot, it went up. Um, yeah, Andy, I love the words. They're wonderful. But wouldn't it be awesome? Wouldn't it be awesome if it looked like this? Check it out, Mark. We hit a termination condition here, and from that termination, when the triggers rolled, I bought the HVA, and it was easy money. And I'm not sure where you did what you did there, but your trade, Andy, was right there. Price reaches the zone, small chart shows change, buy the HVA, and make all the money. And that's the trade right there. Um, and you were close, but it looks like you got in pretty late. It looks like you got in about right here, which is cool, but that's 21,300, 21,310. 21,310 is right here. So you had room. You had room to get to your targets. And you see with all that momentum off the bottom after the HVA trade, that little consolidation, that's no worries, man. Hold that bad boy. Hit your zones when you're coming from that strong bottom. Good job, Andy. It's a good trade. Late on the HVA, good recognition of momentum. We're just going to fine tune you a little bit. Make those charts a little more readable for me. It'll help. 5, 1, 2, 3, 4, 5. All right, Joel. Joel, haven't seen you in a bit. It's nice to have you back in the room. Let's see what you're doing these days. Large chart says odds favorable momentum. Large chart has nothing in the way. You take, there's the fight. I love that. Sold the pullback and lost. You get in, and it doesn't work. It happens, right? And then it turns into a beautiful trend trade with a reversal bar. Look at that. Doesn't that look like a high probability trend trade? Look, right from the mid band, you get in on the way down and you treat it like a trend trade. Absolutely beautiful. Joe, losses happen, brother. They do. You tried the momentum, but I'm gonna talk about the same lesson. Without the momentum here, you're out with an up bar. It makes sense. You get out with the up bar, loss of momentum. It's just a bigger scale. You took the I hope it doesn't stop trade, and it didn't work, and it turned into the perfect trend trade, and you kept your head in the game, and you made money on the way down. Really nicely done. And then there it is again. Odds favorable, clear path. Sure enough, it turns into a trend trade right at those large triggers. You get in on the way up. Absolutely beautiful, perfect trade, Joel, once again. Large chart never wavers. Odds favorable, everything up. Um, you took the first entry, and they came back for you, and then you get back in and you make it. Happens. Does happen. It's the only challenge. Maybe we can do something here, Joel. By the time you get all the way up here, right? Because you had a pretty good run. You went from 95 up to 98. I don't know. I don't know how you manage these with the two big charts. I guess you just have to be willing to take the loss. And great reentry. I mean, beautiful reentry. You get in here, and then you get the second one and just double up. Really nicely done, dude. Odds favorable, potential to break. You get in and make money. Joel, you are consistent, my friend. Hey, David, take care. Yeah, hopefully we're there. Good stuff. Have a great weekend. Are you getting set up on TradingView this weekend? I know that you said, I wanted to make sure that my reply to you made sense. No? Okay. My reply didn't make sense, or you're not going to get set up on TradingView? Either one's, I'll figure it out. We'll just go this way. Holler if you need help. Joel, awesome consistency. Okay, no worries. I'll be here if you decide to. Just awesome consistency, Joel. You've really ironed out all the things that needed ironing out with your trades. Great stuff, dude. It's fun to see you come back a week or two later and still killing it the way you were, which is awesome. Morgan, what kind of trade is this? This is 50-50, huh? Strong top, 50-50, no divergence. Got. This is a tough one, Morgan. Clearly there was some fighting going on in the market. Just didn't work out, man. I'm trying to see if there's something. At the time, those large triggers probably looked like they were getting wide on you, giving you the momentum. It's a good effort. Just didn't work. Yeah, just I can't find. This fits your rules 100%. Strong top. You had the beginning of momentum there. No divergence, strong triggers, clearly defined areas. Stop makes sense. Just didn't work for you that time. All right, Todd. Strong top, momentum. No clear path, I agree. You jump in based on momentum. Todd, were you listening on the momentum lessons? That's it, Morgan. Oh, well, next time. That's it. Next. Bring the next one. So, Todd, momentum in, loss of momentum out, right? Have you guys gotten that lesson yet? Let me open up a small chart here. I'm going to show you guys something that is absolutely amazing. I'm going to change your brains, ladies and gentlemen. I hope. That's okay. Why did you get in, Todd? Give me one word to describe why you chose to take that trade. My guess is that it was momentum because the market was strong and you decided that you would get in below the fib. And you didn't get in below the fib, Todd. You got in at the fib, 100%. You got in at the thing that could create a bounce. One tick below, these are areas, brother. That went 2 ticks below, right? It's okay. So let's talk about it. You made a choice to get in with momentum, right? That's cool, man. That's your right. I don't have any problem with that. That's your life. Live it the way you want to. I want you to see something. These are my small triggers. When does price go the other direction? When I get a close on the other side of the small triggers. And then look at this. Price continues up and doesn't hesitate until I get a close on the other side of the small triggers. So for you guys that are just jumping in, my advantage is gone when I get a close on the wrong side of the triggers. Why is it the wrong side? Because it's the upside, not the downside. Does that make sense? So check this out, Todd. I'm going to show you what that means to you. on just this one trade. Okay, it doesn't matter. It doesn't matter. Todd, you just jumped in, right? Here's your small triggers. I don't care if you jumped in here, here, before the bar closes, whatever, right? I don't care if you get in here or here or here or here. When you get a close on the wrong side of the triggers, that's it. It's party over. Watch this. I'm going to sell the market, and I'm going to put a stop on the reversal bar marker. And until I get a close on the wrong side of those triggers, guess what, Todd? We're going down. As long as I don't close on the other side of those triggers, we're going down. So it doesn't matter that I jumped into a fib, right? It doesn't matter that the bar wasn't done. Until I get a close on the wrong side of those triggers, we're going to hold this trade together as a classroom. Is everybody with me on the experiment? As long as I'm left of the triggers. Every time I get a new down bar, I reduce risk. But look at that. Closed on the wrong side, push down. Closed on the wrong side, push down. Closed on the wrong side, pushed up. So I don't have to put a stop up here hoping that things work out. I can say this is where my advantage has gone. Last time we did this in the room, I think it was like a $700 trade. Doesn't fit any rules. All I did was jump in. So this is today's experiment. Still going. I love this, guys. This is gold. I'm in a short position. I've already been paid. So the experiment, Jared, is as long as this is for the guys that are just jumping in. Ellie, stop. Sorry, guys. This is for the guys that are just jumping into a trade. On the small chart, as long as I don't get a close on the wrong side of these small triggers, this market's going down. See how when I'm left of the triggers, Jared, it keeps going up and it doesn't start that retracement until it closes on the other side. It's going down and it doesn't start the retracement until it closes on the other side. Ellie, no. So the idea on this, Jared, is that if I'm just going to jump into the market, right, my advantage is gone on that jump in when I get to the other side of the triggers. And look at this. We jumped in. Shoot, I should put this all the way down here. Let's see how far it goes. And all we're doing, Jared, is we're riding the reversal bar marker. I don't have any rules, Matt. I don't have a trading plan that says do this. I just jumped in for poops and giggles. But I know, because I understand the mechanics, that until I close on the other side of these triggers, guess what? It's going down. So you guys that want to hold through areas, use a reversal bar marker. Don't be willing to give up more than that. If you're just jumping in with momentum, use a reversal bar marker. Does that make sense, Jared? This is just a way, this is a little example for you guys that just want to jump in. Mark, I don't want to wait for a pullback. Mark, if I see momentum, I'm just going to jump in. Well, if momentum is your reason for entry, a loss of momentum needs to be your reason for exit. And you can define it with a close. No rules at all, Jared. All I did was jump in. It's an experiment to see if the market does actually continue down until I get a close on the other side. So we'll see what happens. If this bar starts back down, guess what? We're still going down, brother. This was a trick that I learned. It's still going down. And every time it produces a new bar, I lock in more profit. We already made $100. Does everybody understand the lesson here? The whole idea behind what I'm doing is if I jump the fudge in, right, JTFI, my advantage is gone with a close on the wrong side of the triggers. So you folks that are working on a management plan, that are embracing this just jumping in trade. And what spurred this was, Todd, look at where you got stopped out. All the way up here at like 59.0150. If you had chased that reversal bar down, you may have had the opportunity to maybe lose 2 ticks instead of losing 3.5 points. Does that make sense, Todd? That's why we did it. That's what spurred this. I love your jump in trades, everybody. I think they're amazing. And look, it didn't close on the wrong side of the triggers. And now they're heading back down. Egads and little fishes, guys. There may be something to this. Still going. Still going. And that's fine, Todd. You start at 200 profit or 200 risk? Or both? Does it make sense to risk $200, 4 points, when your only advantage is momentum? That's what you have to ask yourself. Why the hell would I give up so much money if I don't have to? Why would I give so much to the market if there's no need to? Guys, it's still doing it. I mean, look at this. There's nothing in the way. You're negative 350 in this trade? How could you be? Did you go long? Todd, show me a picture. I don't have it. This isn't a trade, man. This isn't a trade. This is an experiment on whether or not the market will continue down until we get a close on the wrong side. My advantage is momentum. I will hold on to this trade until my advantage is gone. That's all I'm saying. It's the same ideas that we talk about every day when we talk about management. Where shouldn't the market go if this trade's going to be successful? It shouldn't close on the wrong side of the triggers. That's it, plain and simple. John showed me this once because I was trying to hold for bigger moves on the NASDAQ. And I was trying to hold through areas, and I was like, wait a minute. If I get a close on the wrong side of the triggers in an area, I don't have to get stopped out for bigger losses. Whoops, it's still going, guys. Pretty cool. All right, let's see who's next. Steve Diego. Odds favorable, potential to break, perfect entry, easy money. And then with weak triggers, no areas inside, you don't give any of it back. Steve, perfect. 100% perfect. Is it still going? Man, it's still going. Not even paying attention and it's still going. Pete, termination condition. 2 divergences off of a termination condition. You entered anyway. And oh my gosh, you got lucky, right? Pete got lucky. I'll say it in front of everybody. Termination, 2 divergences. Man, Pete, way to dodge a bullet. I told you, even when you try to lose, you can't figure out how to lose. Great stuff. Better dad. Odds favorable, clear path. Oh, you missed the perfect entry and it cost you. The perfect entry gets you paid and break even. The wrong entry results in a loss. Oh, guys, you're still going down. Better Dad, guys, when I say it's okay, guys, when I say great entries create manageable trades, that's what I mean right there. If you're in at 0575, 0550, you literally have $50 worth of risk on this trade. But if you're in way down here, that's where Better Dad, if I'm in way down here, I'm using that reversal bar for a stop. I'm not going 4 or 5 ticks beyond. I'm using that reversal bar. I'm minimizing as much as I can. Does that make sense? Uh-oh, they're coming for us, aren't they? Man, FOMO got you. That happens sometimes. They're coming for you now. You guys are in trouble. Look at that. This trade's over, isn't it? This trade is history. This trade's never going to go down. I can tell because that went from 140 to 1. Oh, no, hold it. No, it is going down. No, it's not going down. My bad. Whew, man. Oh, no, it is going down. No, it's not going down. You guys ever do that? You ever watch those ticks and drive yourself absolutely mad? Doesn't work. But check it out. If you have odds favorable momentum and there's absolutely nothing in the way and you just jump in and you just jump out, you can make a quick $440 in a couple seconds. Ron, this is beautiful. Ladies and gentlemen, Ron is the king of the jump-in trade. Ron invented the idea that so many of you are copying to get in with momentum and path. And I'm going to show you what you guys are breaking in terms of the idea. You guys are saying, I have momentum, jump the fudge in. Ron says, decisions are made at areas. Let me force the price bars to get below the decision-making area. Let me force the price bars to get below the decision-making area. And then it's the easy money. And if you guys wondered what the difference is between you and Ron's trades, is Ron lets price clear the decision-making area. There's a reason he takes 4 or 5 trades a day and then goes chases bikinis at the beach. So you guys that are jumping in into fibs, you guys that are jumping in without a clear path, guys, you're dropping your option, you're dropping your optimization there. There's a reason that price getting below the area has helped. Doesn't what create more risk, Jared? By just jumping in? So Jared, remember when I said that your stop placement is dependent on the trade you're taking? In this particular trade, jumping in here, 7 ticks. That's it. And this is based on Ron's plan. So when Ron takes this trade, because he's away from the decision-making zone, because he has momentum on both, he says, I'll get in here and I'm willing to risk 7 ticks to make 11 ticks. So it's a different trade with a different stop. Because the idea, Jared, is that momentum is the reason for the trade. It's the only reason for the trade. And if the momentum goes away, he doesn't want to be in the trade anymore. But if I'm in a high probability trend trade, well, then my risk is a little different. If I'm in a high volume area trade, one of the other trades you'll end up learning, my risk is different. If I'm in a momentum trade, my risk is different. So every trade has a different stop placement. Every trade has a different management strategy. That's one of the reasons, Jared, that I work so hard to keep you guys focused. You can. I mean, this was 2 contracts. I made $100. Oh, look, it's still going down. It never closed. I made $100 on the first contract, and now we're letting this contract run until we get a close on the wrong side. So it just depends on the trade. This isn't a trade, Jared. This is an example of how this market will continue down until I get a close on the other side. This is not a trade. This is not rules met. This is not a trading plan. This is not me saying get in. This is not me saying take this trade. This is the best of the best. This is me saying as long as I'm not closing on the wrong side of these triggers, this thing's going down. This was a lesson for you guys that are jumping in that keep leaving $200 worth of risk on these trades. There's just no reason. My advantage was momentum getting in. When my advantage is gone, so will I. I will be gone as well. Does that make sense? Jared, this is probably confusing you. This has nothing to do with trade entry. This has everything to do with understanding the dynamics of momentum on the small chart. Because people in this room are just jumping into the market. They're just saying, hey, I don't want to wait for my advantages. I'm just going to jump in. I see momentum. I'm just going to jump in. And when we talk about exits, what we say, why do you exit a trade? I exit a trade because my advantage is gone. That's it. That's the reason for exiting a trade. So my advantage will be gone if I get a close on the wrong side of the triggers. If that never happens, I still have my advantage. And guess what? I'm going to hold that trade. So it's more of a management lesson. I hope that made sense. More often than not, Jared, momentum and path is hard to stop. Well, Pete, that's because you had your stop not where momentum was lost. You had your stop where you were unwilling to give any back. Big difference, right? One is an arbitrary stop placement. The other one has some logic and method to it. And that's okay. So Todd, your ATM strategy. Whoops, hold on. We got to keep locking in money. Your ATM strategy, Todd, you can have multiple contracts. So for example, if I sell the market again, it's going to put me in more contracts. And I can see I have 2 contracts here. I kind of screwed this one up because I shouldn't have jumped in the middle of a trade to do this lesson. But there we go. We jumped in again. And Todd, I'll show you the ATM strategy in just a second. Let me find it for you. So what you can do is when you set up a stop strategy, Todd, we'll set one up together. I mean, my gosh, guys, it won't stop going down. I'm just going to get out of it, and then we'll come back and we'll check and see what it did. Don't care, Pete. Has nothing to do with any management on a trade. Couldn't care less about a large chart. Until it closes on the other side of these triggers, guys, it's going down. Period. End of story, 100%. So Todd, over here, these are your stop strategies. So these are how your stops and targets are going to be placed when you get into a trade. And if I click custom, so let's say I was going to trade that chili dog trade that Ron trades, but I want to do it on 5 contracts and I want to split things up. The first thing you do every time you set up an ATM strategy is you have to have your order quantity. So Todd, if you're trading 2 contracts, make sure that it says 2 contracts under order quantity. It's still going, Pete. You didn't want it that bad. It didn't want it that bad, not yet. And then Todd, once you have 2 contracts up here, you have to make sure that you have 2 targets down here. So you're going to click add. So my first contract, I'll have 1 contract for target 1. I'll have 1 contract for target 2. My stop loss, depending on where I'm at, if I'm trading crude oil or the S&P, Todd, I like 12 ticks. Take care, Ron. I'll see you next week. I like 12 ticks because 12 ticks gives me the ability to put my stop where the market shouldn't go. And if I want 2 different targets, so let's say my first target, I wanted $100, I'll put it in 10 ticks. If I want it $200, I'll put it at 20 ticks, and then I'll just save it. I'll save the template, I'll call it the KISS plan. And then if I just get into the market, I've got 2 targets. and I've got a 12 tick stop. So if I need my stop to be at that reversal bar, I can move it down. If the market goes to my first target, it'll pull that one contract off and it'll leave the second contract in play. And all of that is they changed everything. There we go. And then here are the instructions that go with that little lesson. Did that make sense, Todd? So you're going to trade multiple contracts. Oh my goodness, look at that. A close on the wrong side of the triggers. That's it, right? So you guys that just like to jump in, when did it start pushing up more? Does everybody see it? Does that lesson make sense? I love this lesson. Because every now and then that thing runs. Every now and then that thing screams. And it might go back down, but now I don't have the advantage of momentum, right? I'm willing to take that exit. And then Todd, you've got tons of ATM strategies preloaded in there too. So anytime you see two contracts, it's going to have multiple stops. Play with it a little bit. Look at those. Yeah, the live lessons are fun. And you guys know that wasn't a lesson on how to trade, right? That wasn't a rules-based trade. It was directly into a fib. The only lesson here was that the market is going to continue down until you get a close on the wrong side of the triggers. And that's your exit reason. Because what could happen, and I don't know what the large chart looks like, that reversal bar is the beginning of a potential pullback. And with this look, what am I doing? Once that reversal bar prints, I'm looking for areas inside of triggers. I'm hoping for a trend trade. When the conditions are right, guys, and your momentum trade fails, very often it becomes a trend trade. Pretty cool. It all ties together. We'll see how far it retraces up. But if you're holding this trade, guys, you have to say with this reversal bar, it can go up another $120 to the area where it may continue back down. And wouldn't it suck if this was one of the ones that failed and you got stopped out at 60.50, break even, instead of getting paid all the way down here where the momentum was gone? I'm telling you, management, guys, you got to learn to manage your trades. But this is one of the best expectations. And look what's happening. Hope sucks. I'm not smart enough to change my plan every trade based on my emotions, guys. My emotions will get the better of me every time. Every time. Price is at a decision-making area. And look at this. There's a fight. I did say hope sucks, Jared. I hope you don't find the word sucks offensive. It's old slow. It's smooth. Crude is smooth, guys. S&P is smooth. They're not difficult to trade. And this entire class is dedicated 100% to giving you the best of the best entries and just understanding that you're going to grow from it. All right, better dad. Is it really a clear path? Let's talk about it. What do you beg to differ over? I say a lot of things I may have missed. What are we differing on? I like it when you guys differ with me. Well, it's because you're making mistakes. Smalls are through the area. Large are not. Not a clear path. This is a 50-50 look. So the potential to break is there. The most successful 50-50 trades come from a strong bottom. That's rule 1 on the KISS plan. So already you've convinced yourself that it's a clear path when it isn't. That becomes problematic. And you've broken the first most important rule coming from a strong top or bottom. And you had 2 divergences print. 2 divergences print. So better, Dad? The ES is doing everything we would expect it to do. You, my friend, didn't have a strong top or bottom. Hold on. You didn't have strong triggers on the small chart. You had divergence on the small chart. You broke 3 out of 4 rules, my friend. I think you got exactly what the expectation should have been. Does that make sense? I'm not beating you up. I'm not giving you licks or sending you to the penalty box. But this is one of the things, and I go back to language. You're screwing up the ES today. Better, Dad, there's this phenomenon that happens when you start to get good, and you're at that point, my friend. You are starting to get good. And when you start to get good, one of the things that happened to me, so I'm not going to say it's happening to you. I'm going to let you guys know that it happened to me. When I am the most dangerous as a trader after about 5 to 7 positive days. Because after 5 to 7 positive days, what happens is the doorbell rings and my Superman cape gets delivered. They're not invincible, Jared. They are not invincible. Yeah, okay, I see what you're saying. I do. I start to feel invincible. I'm like, holy crap. My rules aren't why I'm winning. I'm winning because I'm kind of a big deal, guys, because people know me. I have many leather-bound books, and my office smells of rich mahogany. That's why. No, I like to be polite, though, Todd. I really do. I like to be polite, but that's when I screw up, is when I've had a run of success. That's when I start to think that I'm a little bit smarter than the rules. And I'm not saying, better, Dad, that that's what you did. But what I can say is without hesitation, question, or any lack of confidence, is that you have been showing me rock star pictures all week long. And this one breaks 3 out of 4 rules. It's a don't bother. Man, if I'm not mad at you, don't worry about being mad at yourself. Yesterday, better, Dad, I was trading on TradingView. And I was following the trading plan that I give you guys for it. And I took 2 trades that broke the rules. 2 times I formed an opinion because I was up about 4 grand. And I was like, man, I can do no wrong today. And the second I did wrong, the market punished me. And it's, I just, you can be mad at you if you want. I'm not going to be mad at you. I think you did exactly what humans do. And now, instead of shutting down NinjaTrader, why don't you tape up, play hurt, and take the right trade next and prove to yourself that you're good at this? Prove to yourself. You know what you're looking for. You've proven it day after day. Now we're just looking to repeat it every day. All right. Joel, strong triggers, everything down. And you made money? Right on. I like that. Always walk the dog. Let me figure out what you did here. You took a long entry at 9:59. 9:59. All right, Joel, I love it. So Exhibit A. Joel, everything said down strong, and you went long. You let a small chart talk you into fighting the big chart. Didn't work out. That's an avoidable loss, my friend. But the cool thing is you got your head back in the game and you traded with momentum and path and you made it back. Nicely done. And then this chart says down And this chart has all the termination conditions, so you get in on a reversal bar, and that makes sense. So, Joel, does that make sense? That's the one that you fought. That's the one that punished you. The one time you broke your rules is the one time you showed me a loser today. Good job. And then when you got your head back in the game and followed your plan, you made the money. Guys, everybody does this. Everybody does this. I don't care who you are. You're going to break a rule every now and then. It's not the end of the world. It's just not. I promise. All right, Jared, we're going to talk strong top or bottoms for you real quick. And then Jared will also do the ATM strategy for you. So strong top or bottom. I'm going to give it to you twofold. The first part is going to be haiku. We're going to go 575 and make sure that you understand it. The second part is going to be through a series of clicks and beeps getting you where you need to be. All right, I'm going to do this. I like to give fish and I like to teach you to fish. So, Jared, there's a document on strong tops and bottoms that'll prove to be helpful for you. But I'm going to give you the rundown too, so you have at least a little bit of a something to go with it. I couldn't think of the words there. My bad. Okay, so a strong top or bottom. First, it's a termination condition. I can't stress this enough. And this is the same picture that I use to teach termination conditions. So a strong top or bottom. And Jared, you'll discover that I use words to describe it a lot. I use definitions a lot. I use repeatable phrases to make sure that when you're wondering if it's there, if you learn this, you'll know your answer. So a strong top or bottom has to be a termination condition first. There's no getting around it. And then that termination condition reverses the market. Not the color change, but the large triggers rolling from green to red. Or price reaches Fibonacci support and the large triggers roll from red to green. So first it's a termination, then it becomes a strong top. That's about 4 or 5 bars later. First it's a termination, then it becomes a strong top. And this is the only way you have a strong top or bottom. And what does it mean? And again, this is me just putting words in the mouths of people that are moving the market. So right here, the buyers owned the market, owned the move, all up. At the termination condition, the sellers took over and reversed the market. So I talk about those decision making, right? The decision making points. The decision was so impactful that the buyers lost every bit of momentum that they could ever have, and the sellers took over completely. And that is huge because that means that the tides have changed. And the great thing about these strong tops and bottoms, Jared, is there's almost always one last ditch effort by the buyers. And that's what creates that highest probability trend trade that you could ever take, because more often than not, after a strong top or bottom, those buyers fail. Thanks, Steve. Have a great weekend, man. So when you go through it, if you want to study strong tops or bottoms, and you just keep the definition in mind. Let's see where we can find examples of both. Price reaches Fibonacci resistance. First, it's a termination. When those triggers roll, this becomes a strong top. Does that make sense? Cool. So that's a strong top. Here, the market turns from nowhere, and even though the triggers roll, this would be considered a weak bottom because it doesn't come from a termination. Are you with me? So check this out. From a weak bottom, hits the midband and resistance, and continues down. And now here's our next pivot. Strong or weak? What do you think? These pink 1-to-1s are not in the termination list. If they were, that would be. So you have to pretend that those pink 1-to-1s aren't there because they don't count on crude oil. So no termination condition. Are you thinking because of the divergence line? This is really common. So I don't have a termination condition here. Which line? The pink 1-to-1s? I thought I took these off of my charts. Right on. Nope. Okay, so I see what you're saying. No, they don't, Todd. They're small swing 1-to-1s. They come into play on the NASDAQ charts, but they're on every workspace. So, all right, Jared. So this is where we open the door for a really cool lesson. Dun, 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 dun. Because this is important, because what you said, no, you're right on the divergence thingy. But let me show you something. Get rid of this. And I'm going to get rid of this. Hell, I'm even going to get rid of trigger lines. And I want you to see something. The only thing I'm leaving on is divergence. And I'm going to find a good example. Whoops. Sorry, I'm going to make you guys dizzy real quick. All right, I'm going to do this. So check it out, Jared. The market goes up, and this is where it stops. That divergence line is 100% where the market stops. But we don't know about that divergence line until 2.5 bars. So it takes 2.5 bars to print the divergence line. So price doesn't reach it. It actually creates it. That was horrible. Does that make sense? So price goes up, down, the calculation runs, and then this bad boy prints. So this divergence doesn't print until about right here. And this divergence doesn't print until about right here. And this divergence doesn't print until about right here. So anytime you see a pivot with divergence, price didn't reach it. Price created it. But when the market comes back and it reaches that already formed divergence line, that's when divergence becomes a termination condition. Jared, if I had $1 for every time I've given that lesson, I wouldn't be here teaching. I would be on my private island, because that's one of the most misunderstood concepts. Because divergence printing, it happens, but you don't know about it until just a little bit later. And it's when price comes back and reaches one of those areas. And let's see if we can find one acting as a termination condition. And of course, there's not going to be any good ones. There we go. That's a pretty good example. The loss of momentum is created here. Oh, there it is. Perfect. But it's not a termination condition until it comes back and reaches it, and the triggers are below. So that was kind of the trick question, I think, on that one for you. So here, where was that picture? I know we had one. Not a strong bottom. Does that make sense? That's a long way to get there. That's it. It's just kind of a loss of momentum and a pivot. That's all it is, not a termination. And then look what happens from a weak bottom. It goes up to the termination condition, to the midband, the fibs, and it continues down to the next Fibonacci area. And this is a very common pattern, Jared, is when I have a weak bottom, very often the midband holds, the areas by the midband hold, and the market loves to continue the trend. And then it pulls back and it does it again, and it loves to continue the trend. Bad top, it hits the midband and they try to continue the trend, but they can't. Weak bottom pulls up, and they continue the trend. Your wife suffers. So what you're going to find very often is because the people in charge know where these Fibonacci areas are. So there's your bad top. It comes down, reaches support, and they try to push back up, but they can't. And then it continues down and it goes to the next Fibonacci area. Here they come through the areas, bad top, hits the midband, continues to the next fib. And you're going to see this repeat itself all day long. Bad bottom, up to the midband area, continue to the next fib. And that idea that a bad top or bottom, very often creates continuation in the overall trend, that's why those 50-50 trades after a weak bottom are less likely to work, because the market may want to continue back down. That was an awesome lesson. Supply and demand is a different concept. Supply and demand is more about higher highs and higher lows, areas of consolidation. So if I were doing supply and demand levels, I would probably see that area of consolidation, and I would say to myself, this area right here, let's see if we can find an example of it. There it is again. See how there's an area of consolidation right here in the same area? Pretty cool, right? There it is again right there. So what this says to me is that this was a key area, and there was consolidation and the market couldn't make decisions. And this is pretty neat how supply and demand works. And I want you to see what happens. The market goes up, and I'm going to extend that, and it pulls right back to the top of that consolidation area, and then it continues up. That's how supply and demand works. Supply and demand identifies key areas within the market historically, and it extends them forward. So if I were going to have a supply and demand zone, it would probably be right in that area there. And you can see how the market reacts. Fibonacci is a different concept. Fibonacci, and the way the market, the software does it, is on every chart you have, every up, every down, every this, every that, all of these, each and every one of these, all the way through. It does it on this time frame. I believe it goes back 10 days, creates higher and lower time frames, projects forward, looks backwards, and from all of these, what you get are about 10,000 calculations. So every Fibonacci retracement, every Fibonacci, let me grab the Fibonacci tool here and I'll show you exactly what I mean. From this pivot to this pivot creates all of these potential Fibonacci areas. Does that make sense? But where's my Fibonacci stuff? From this pivot to this pivot creates areas. And from this pivot to this pivot creates areas. And from this pivot to this pivot creates areas. That gets confusing as hell. My brother had no idea he was this smart, Jared. Creates this algorithm that says, all right, from 10,000 Fibonacci calculations, which ones are the most important? Which ones have the highest concentration, the most important Fibonacci levels? And from all of these shenanigans come these amazing Fibonacci areas. And if you look at it on a big scale like this, you can see just how powerful they are. So now that I know where highs might be, and now that I know where lows might be, I can use a couple simple rules to help me capitalize on the best of the best moves, trading away from them, trading to them. And that's kind of what we do. So it's different than supply and demand, but it is very much key areas. Does ES or S&P switch from June to September automatically? Um, you have to roll it on NinjaTrader 8 though. It'll give you a heads up, Todd. And what happens is the S&P, when it is the roll date, NinjaTrader will put a note up for you and it'll say, "Hey, do you want to roll?" It is quarterly on the S&P, absolutely, and it's monthly on crude oil. So crude oil you'll roll every month. S&P you'll roll every quarter. But NinjaTrader will literally, when you open up on the roll date, it'll put a big thing. Hey, contracts are rolling. Do you want to roll? I love these questions, guys. So ATM strategies. What is it? Automated trade management. Oh, Miss Jen, have a great weekend. Thank you for being here this week. You've been trading like an absolute rock star. I hope it's reflecting in your earnings. Patience, patience. It's so much fun watching you guys mature as traders. Great work. Always great work. All right, ATM strategy, guys. That's so over here, Jared. This is your little chart traders section. In your ATM strategy, all this does is this is saying, hey, this is how I want to manage the trade at the point of entry. So this is the KISS parameters for crude oil. It's two contracts. This is straight out of the plan. And let me show you. So when you click edit here, it shows you this. So I'm trading two contracts. And I have two different targets. And that's what the targets show you, two different targets. Your stop loss, and what this says is if I enter a trade, my initial stop will be 12 ticks from my entry. Not the correct stop, but 12 ticks gives you time to put it in the right spot. Does that make sense? 12 isn't the magic number. 12 gives you time to move that stop to where the market shouldn't go in a trend trade. And then over here you have targets. My first target is 10 ticks. My second target is 20 ticks. So every time you set this up, and guys, these are set up for you. You can make your own. You can play with it. You can do all these different things. What it's saying is that if I choose to enter the market, I'll sell it just for grins. If I enter the market, my initial stop is 12 ticks. My first target is 10. My second target is 20. If I need to move my stop to where the market shouldn't go, I can click on the line and I can put it anywhere. If I put it below price, it'll stop me out. But the original stop stays in place until I click again. The same is true with targets. Maybe I've got trouble in the way and I want to take a smaller profit. I can put a target right there. If it hits my stop, it'll pull me out of the trade completely. I sold two, it'll buy two and flatten me. If it hits my first target, it'll remove one of the contracts. So now I'm only in one contract with the second remaining. So if you guys are brand new, I would definitely encourage you, go through, practice getting in, practice getting out, play with different stops and targets, practice moving them, all that good stuff. If you're on an iPad or cell phone, you can only click buy or sell. There are no setups with ticks. You're welcome, Jared. Andy, hold on. Let me open up my iPad real quick. I don't have the answer off the top of my head. So I'm going to open up my iPad charts real quick. Shit, I can't because I don't have internet on my iPad. Sorry. One second. Let me get my internet set up and we'll be good. But I don't know. I'll look into it. Do you have when you open up, gosh, I posted one in the room, but I don't remember where it went. When you open up your iPad, does it have the trade tab? Okay, hold on. It says that I have internet. There we go. Hold on. I'm looking at it. You couldn't find it. Let me get my charts up real quick. Watch list. I don't think I'm signed in. I am. News premium. That's me. Chart reload. All right, so I've got it up. At the very bottom, let me figure out where it's at for you here. You've got your buy and sells, right? Hey, Russ, take care, man. Have a great weekend. Andy, I'm just going through it. I'm clicking every symbol that I have. And it doesn't look like it. It doesn't look like I have a way to put in stops and ticks. Nothing that I see. I would say go to the Google webs, and they'll probably get you that answer. Todd, the more you learn, the dummier feel. So, Todd, I'm sorry that you feel that way. But one of the things that you can do, and Andy, if I come up with it over the weekend, you know that I'll message you. Todd, one of the best ways to stay out of that brain fog is keep it simple, man. Get really good at one trade, whether it's the high probability trend trade or Todd, if you're taking the jump in trade, that's okay. You seem to be drawn to that. But what you learned today, the only thing that you may want to adjust is if you get a close on the other side of those small triggers, it's all right to exit. That's it. Everything else you're doing is pretty solid. Keep doing it. If you want to learn how to take that jump in trade the highest probability way, there's Ron's rules. There's all of my study on it and tons of pictures. Steal it. Maybe it'll be helpful. Guys, are there any other questions? I know we didn't really talk about TradingView a whole lot, and that's okay. Do you guys have any TradingView questions? I've got time. It's Friday. I got nothing to do. Mama's working.